Good morning. It is Tuesday, September 27th here in New York City. This is Yahoo Finance Live, and the band is back together. I'm Julie Hyman with Brad Smith and Brian Sazi. However, we don't have a lot of positive stuff to talk about. We are seeing futures bounce this morning. Let's take a look here at the globe. And indeed, we are seeing indications for a higher open for the major averages here in the U.S. with the Nasdaq leading the gains. And we saw that across much of the globe as well, although the gains in Europe somewhat tepid at this point. London, for example, just up 0.4%. You see a couple areas of red persisting after the veritable carnage that we saw continuing yesterday. The Dow Jones Industrial Average down more than 1% in yesterday's session. And let's look at a quick year-to-date chart here. The Dow made its high for the year back on January 4th. I have to cop to admitting I thought the Dow was already in a bear market, but it wasn't until yesterday when it did close down about 20%, 20.5% from that high that it reached back on January 4th. So it was the last of the big three to enter that bear market. The other two, of course, never got out of the bear market, right? We had the S&P still down 23% year to date and the Nasdaq down sharply as well. So a lot of concern out there. One more thing I do want to highlight is what's going on in bond yields. The 10-year note, we are seeing it come off a little bit, 3.8% and went as high as 3.9%, really reflecting the acute concerns about recession here, not just here in the U.S., but we're seeing those concerns really spread across the globe. We're going to talk about how that continues to reflect in currencies in just a moment, but we got to get to our three things and the implications of all of this, Saz.
All right, everything Julie just mentioned is causing more bearishness on Wall Street. Now, big financial institutions like Goldman Sachs and BlackRock are turning sour on stocks, with Goldman downgrading equities to underweight and BlackRock telling investors to, quote, shun most stocks because the market is not priced in a global recession. Let's start on this BlackRock note because it made me chuckle a little bit. Great analysis, but still, first sentence out of the gate in this note. Many central banks aren't acknowledging the extent of recession needed to rapidly reduce inflation. Markets haven't priced that, so we shun most stocks. Simple analysis, but to me, it makes a lot of sense.
Well, it's about the individual names, too, that we should be looking at and paying closest attention to, and especially for the largest firms that are tracking a company like even Apple. Yesterday, we saw the majority, if not all, of the Dow components, except for four, in negative territory. Apple was one of them that retained its gains, and that says a lot about the strength that a company in Goldman or even BlackRock would really cite at this time. Companies with strong balance sheets, cash to be able to deploy, and then additionally a company like Walmart that ultimately was able to close the day in positive territory too. A brand that's still going to retain a lot of the consumer mind share, even if it is just making sure that you get them in the store for the grocery department, but then hopefully some of those dollars also transition into other categories within the brand too. And so within that, I think that's what really plays out within some of the ratings that we're going to get in this near-term period as a defensive play from many firms too.
Yeah, so you have that sort of conversation and decision-making process on the part of investors, right? Mm-hmm. What are going to be the plays that could maybe work in this environment? How long is this downturn going to last? A lot of discussion about the market internals, right? The technical indicators in this market. Bespoke is one of the folks, one of the groups, one of the companies that is looking at that. And they were looking at the advanced decline line of the S&P 500. And that indication, when it goes below that green band there, stocks are so-called oversold, right? So we could be potentially looking for a bounce. I'm looking at some of the other indicators that Bloomberg analysts were highlighting. For example, over 50% of stocks are in bear markets, are down at least 20% from their highs. They're also looking at the news highs and lows in the market that are hitting extremes. So there's a lot of sort of trying to read all this. Are we at so-called capitulation? Are we at, when Goldman and BlackRock throw in the towel, is that a signal that things are as bad as they're going to get? We thought that maybe back in June. But here we are retesting the lows.
It doesn't seem that way. And Goldman, just digging into that note a little bit, they are downgrading equities to underweight over the next 3 months. What does underweight mean? Essentially means we're selling stocks. We're less optimistic on the outlook short term for stocks. And that when Goldman sets this call, that means analysts probably across their sector that cover a lot of these companies, whether it's Apple, Walmart, a Caterpillar, you name it, they're out there lowering estimates, their profit estimates for the next couple quarters because of what this economic team, this strategy team is in fact saying. But we're seeing now, I think, the knock-on effects of the market turning down, economic data continuing to sour, and now you're seeing Wall Street firms try to play catch up to all these things happening, and that is likely to put more pressure on the markets.
Yeah, look, within this, the BlackRock Investment Institute, they had said that many central banks aren't acknowledging the extent of recession needed to rapidly reduce inflation, to your point earlier. And so that is really something that across the board we're seeing play out. Even if we look at currencies right now and kind of look more broadly globally, let's take a look at the US dollar index. Currencies here, the dollar is up against most major currencies right now. Let's bring in Yahoo Finance's Jared Blickery for more on this too. Jared?
That's right. And looking at our currency heat map, now everything here is based on the US dollar. Some of these are inverted to what we normally see in Forex land, but if it's green, that means the US dollar has advanced today. So taking a retreat with respect to a lot of these currencies, but let me just pull up the Chinese yuan. I don't know if we talk about this enough, but this has been on an absolute tear this year. You can see up about 12, 13%. That is a huge amount in currency terms. And I just want to reiterate this point because I want to hit it home several times as I've been doing that these huge moves in currency land, these have spillover effects because these trades are all highly leveraged. Same thing in the bond world, so that when we see bond markets and the currency markets heat up, well, that spills over that volatility into equities. Now, let me show you what's happening on a 1 month basis, because we are now seeing the US dollar advancing over 11% versus Norwegian krona, versus a British pound, it's up 10%, versus the Australian dollar, 7.5%, South Africa, Sweden, Argentinian peso. You get the picture here. These are huge moves. And all of this, well, a lot of these countries are borrowing in US dollars. So this has knock-on effects for emerging markets, has knock-on effects for commodities, which are priced in US dollars, especially WTI crude oil. The entire world plays in that trade. And so we see a lot of fallout from this in the equities markets, guys.
I want to zero in on the pound for just a sec, Jared, because obviously that's the one that's really been most in the news in the past week or so, as we've gotten the new plan from the government there, and it's really been acute pain for the UK based on all of that.
Yes, it has. And this is the US dollar versus a British pound. This is inverted, but this shows you this huge spike up yesterday. This was when the US dollar strengthened versus a pound. A lot of people are calling this a mini flash crash. And you take a look. Let's take a 10-year look back. Now, when we go back all the way to 2016, 2015, this was the area of the Brexit. And this is when the markets were pricing this in. This is when it finally happened. Let me just show you what this was happening with the normal cross. When we are looking at this from their perspective, it doesn't look like I'm going to be able to get that right now, but nevertheless, George Soros was betting on a level of 1.2% with respect to the British pound, and now we are approaching parity. And so I think that's good news for shoppers who are going abroad and spending their dollars, but not necessarily for those people living over there. This has yet to play out fully. I want to make that known. These flash crashes that we're seeing in various currencies, probably going to have a few more of those because we are in a liquid market situation, and it's going to take a lot more than Federal Reserve jawboning, for instance, to cure this situation.
Glad you mentioned the Federal Reserve there, Jared. We're getting some commentary this morning from Fed Chief Jerome Powell on cryptocurrencies saying, quote, there's a real need for better crypto regulation. What are you seeing there? Any moves there in the early going?
Yeah, crypto is actually heating up. And let me go back to one of our heat maps here for crypto. Been really nice to see this move because we were teetering on very, very sketchy territory. Now, you'll notice this is a 10-year chart here. 20,000 was the level in late 2017. Those were the highs. And although we've breached those, we've gone all the way down to about 17,000 and change. We have more or less respected those levels. Here's a year-to-date look. You can see here's where we went down to 17,000, basically testing those levels right now. Huge basing period for crypto, for Bitcoin right now. If we can break to the upside, let's say, if we can break 25,000, 26,000, that is a big resistance level. And then we can think about some of these other big psychological levels like 30, 40,000, but 25 is a big one. If we breach 17, I think this crypto winter goes on for a long period of time. Let's take a look at the 10-year one more time. Yeah, it took a long time to rebound from the previous one. This was 3 years, and it could be a similar amount this time, but we got to hold those lows, guys.
Yeah, I was going to say, it's a lot closer to that 17 lower bound than that 25 upper
Good analysis.
of that
I like
range.
that. Good.
I mean, it's just like if we get to 25, but then it feels like a big
It's all
if.
about the feels.
Is all I'm just trying to say right now. Thank you, Jared. Appreciate it. And as Saz mentioned, we're continuing to hear from a slew of Fed speakers this week after Fed Presidents Charles Evans, Susan Collins, Raphael Bostic, Loretta Mester. They already spoke, signaling the Fed will continue to prioritize pushing back against inflation. We also heard from Jay Powell, specifically with regard to crypto. Yahoo Finance's Jen Schomburger has her hands full, covering all of that commentary. What stands out, Jen?
Good morning, Julie. That's right. After that blackout period ended and the Fed hiked rates last week, Fed officials are out in droves, speaking over the past 48 hours, underscoring their resolve to fight inflation. We heard from Chicago Fed President Charles Evans this morning. He says the Fed needs to raise interest rates by at least another percentage point this year, a more aggressive stance than previously embraced. Evans also said he does not see, quote, recession-like unemployment rate numbers ahead, even as the Fed sees the unemployment rate rising to 4.4% next year, a jump from current levels that some economists say could usher in a recession. Now, we also heard from Cleveland Fed President Loretta Mester, who says that the Fed should raise rates higher and keep policy restrictive for some time since inflation is, quote, unacceptably high. She underscored it's better that the Fed err on the side of doing more rather than doing less, even if that means a policy error, i.e. potentially a recession. We also heard from Susan Collins, the new president of the Federal Reserve Bank of Boston, in her first comments since taking that post. She says that she's committed to bringing inflation down to 2% and supporting higher interest rates that we saw the FOMC put forth last week. She also says that that's fine, even if that means that the economy slows. Now, elsewhere, as you mentioned, we heard from Fed Chair Powell this morning, who was participating virtually in a conference put on by the Bank of France on regulating crypto. Powell said there's a real need for regulation as DeFi expands. And he says, while some crypto resembles traditional financial banking activities and could be regulated using traditional banking regulations, other aspects are more novel. And he pointed specifically to replacing intermediaries with smart contracts, and that would require perhaps different sorts of regulation. Now, the Fed chair also weighing in again on a CBDC. He reiterated that no decision has been made, and there probably won't be a decision for some time. He said it's going to take a couple of years, actually, before the Fed can solidify its analysis and conclusion.
And
Guys?
Jen, while we have you later on today, actually just after the trading session kicks off, we're going to be set to hear from the St. Louis Fed President James Bullard. What signal could he strike different from what we've already heard from other Fed presidents, and especially as Bullard has been known to be more hawkish, more aggressive over the past rate decisions as well?
Yeah, I mean, it was a unanimous decision as far as the 75 basis point rate hike last week. But I do expect him to come out quite hawkish. The latest numbers we've seen on inflation, particularly that CPI number, was quite hot. And so it seems that the Fed still needs to do a lot of work here. So I would expect him to be quite hawkish. Will he say, hey, yeah, we could have gone 100 basis points? I mean, I don't know. It remains to be seen, but certainly we'll be keeping a close eye on that.
Whether it's hey, yeah, or hey, yeah, we're going to be paying close attention to whatever St. Louis Fed President James Bullard says. We appreciate the breakdown here this morning, Jen. We'll check in later. Guys, coming up, why our next guest says that investors should not be waiting for the Fed to break something. Charles Schwab's Kevin Gordon joins us next. Welcome back to Yahoo Finance Live, everyone. Major averages holding on to gains this morning after the Dow finished yesterday's trading session in a bear market as concerns surrounding the world economy takes center stage. For more on the latest market action and sentiment, we've got Kevin Gordon, Charles Schwab, Senior Investment Research Manager. Kevin, thanks for joining us in studio, live in living color this morning. You say that investors don't need to wait for the Fed to break something. Break that down for us.
Well, I think if you look at the housing market, it's already happening. And you kind of have to break it down in the different phases that you tend to see with weakness in housing, starting on the sentiment side. So something like the NAHB, home builder sentiment has deteriorated rapidly. And if you look at rates of change within whether the headline index itself or prospective buyers traffic, that is firmly recessionary. And it's starting to wade into other areas like home sales. New home sales, existing home sales have been basically cut in half from their peak. And now you're starting to see it creep a little bit into prices, but we haven't gotten there yet. And that is the part that's the issue really for inflation and ultimately for the Fed and the broader economy, because they're looking at that not coming down as rapidly, feeding into higher rental inflation that's going to be a little bit stickier later. But if you want to look for something that's breaking, I would say it's already happening in the sentiment components of housing itself.
Yeah, we just got house price numbers, but they're for July, so it's trailing. We get new home sales out at 10 a.m. Talk to us about how we should think about, we know why housing is important, but sort of put it together for us. And when we look at home ownership rates in the United States, et cetera, why is it such an important thing to look at for the status of the overall economy?
Well, the ripple effects from housing are massive, not just from a confidence angle, but also when you think about affordability, the fact that, monthly payments have gone up significantly for homeowners, but also, the potential entry into the home market is completely almost been shut for would-be home buyers because of the spike in mortgage rates, because home prices have taken longer to come down. So I think that, in terms of slowing down the economy, you could do it pretty effectively. But it also, in a good sense, I would say that the positive spin on the housing bubble this time, more so the price bubble, not anything akin to what we saw in 05, 06, is that you don't have high, debt service to income ratio. You don't have high household, debt relative to income. So that is the positive aspect this time. But for the Fed and them wanting to sort of stem any of the inflationary pressures and keep it, at bay, that's largely been successful, but we have to now see it and wait for it to feed into lower price growth over into the future.
Kevin, investors waking up today, they're awakening to see all three major indices in a bear market. And investors have been largely taught that investing in something that tracks these indexes is the best way to go. But is that broken? Does that still work? Should investors be more now pivoting to stock picking, especially given the pullbacks we've seen, like in tech, for example?
Yeah, we've been in favor of a little bit more of an active approach as the bear markets progress this year. The only rub with it now is that correlations have picked up a lot. So it's if your entry point is around now, which I wouldn't argue ever for a get in or a get out strategy, but if your entry point has gotten a little bit closer to the near term, it's a little bit tougher to do that. But there are still factors that work. And I know last time I was here, we talked about screening for high quality, specifically earnings quality. And that has been actually the key outperformer, not just the past 3 months, 6 months, or year to date, for the past year. That's been where you've been able to find consistent outperformance across every sector.
How do you know it's quality? Like what defines quality in an environment that with GDP is barely growing?
Anything with earnings strength, whether it's trailing profit margin growth or forward estimated profit margin growth. And specifically, the market's going to put a premium on whatever is scarce. So if you look at the percentage of companies in the S&P, for example, that have positive earnings revisions, that have had them over the past 3 months, it's only 30%. That's down from about 90 a year ago. So that rapid deterioration has elevated the companies that have done really well from that earnings profit margin, forward-looking perspective.
What about on the employment front, and particularly on the unemployment side? What we've been hearing is that even if we're looking quarter over quarter now, and actually a year out from now, thinking about when the deepest components of a recession might hit, what unemployment may actually look like at that point in time, what would you be tracking most notably going into that period too?
Well, in the leading sense, claims for sure. And the good aspect of that from the consumer or the employee perspective is that claims have started to roll over. So we've reclaimed almost half of that spike that we've seen since April, which is great. Not so great from the Fed's perspective, because that just signals that company demand has actually been relatively strong if people have been able to find jobs at a quicker pace. But moving more into the coincident areas like non-farm payrolls, even within that, non-farm payroll growth still looks pretty strong. But if you look at something like the household survey, they both diverged. Household survey's been relatively flat. Non-farm payroll survey has still been strong. And then, in a lagging sense, the unemployment rate, which we would never look at for, any sort of leading indication as to where the economy is going. But implicit in the Fed's forecast, you sort of bring up where unemployment can go, is a 4.4% unemployment rate by next year. That's a 0.7% jump from where we're at right now. That is, that's a recessionary type jump when you look back at history, for the trough in the unemployment rate to the start of a recession. So I just think from our broader perspective and all of us at Schwab, it's really tough to thread that needle and to sort of get this immaculate scenario where you have GDP just sub, trend growth with unemployment rising a little bit and inflation coming back down. One of those sort of has to break and not really work. And I would argue that probably unemployment, once it's out of the bag, it's really hard to get back in.
Well, there's a lot of stuff breaking out there. But Kevin Gordon, good to see you in the flesh. Appreciate you coming down. These are busy times. Charles Schwab, Senior Investment Research Manager. Good to see you. All right, coming up, we'll dive into a few movers on the Yahoo Finance platform, including AMC and Hertz. Don't go anywhere. Hello, hello. As we await today's opening bell on Wall Street, there are a few hot tickers on the Yahoo Finance platform this morning. First up is the always volatile AMC, and really an ugly session or a close yesterday for AMC. The basic gist is this: they're looking to sell more of these APE preferred shares that could potentially raise up to $1.6 billion from this. So the basic read was that this is negative for AMC stock, perhaps better for APE. But again, these tickers have been hot on our platform the past 24 hours. Makes sense. It's always a volatile name, especially around developments like this when AMC tries to raise cash to pay down debt.
Right. Looking to raise this to kind of pay down some of their general corporate expenses. But for all of what AMC has done to try and shore up liquidity, just to navigate whatever the reopening process continues to look like for movie theaters, and in the face of, I mean, they've been able to benefit a little bit from some of the big titles that have come to theaters, but it's largely the shift in how consumers are willing to spend those dollars, and in an inflationary environment too, where perhaps seeing the most movies of any year, recent years, this year because of titles.
Thanks for the invite.
No, yeah, I'm sorry. It's usually a last-minute decision. I got to
Have
do
you
some
seen
number
anything
crunching.
since the Woman King? That was the last one
that
we
was
talked
that
about.
was the last big one, right?
That was just a couple weeks ago.
Right. I'm not going to go see Avatar, the original one again, because that just got re-released. But I think it really is on the strength of titles that AMC has to bank on, as well as the availability for some of the customers that are there to also just continue to go back for whatever that movie might be at a time where also, why are we going to get a resurgence or a reboot of MoviePass too? And so all of that considered, you're going to see more of the AMC Stubs List members try to get wooed by an AMC to just continue to come back for any movie title, but they're not going to do that. I don't think that's going to be the reality.
Well, the bottom line is AMC needs more cash, right?
Yes.
And the fact that it is raising that cash the company has always been very transparent about that it was going to continue to do this, that it might sell more of these ape shares, right? But the fact that they're doing it, that they still need to tap the markets, and that they are tapping the markets in a rising interest rate environment, because there was the report on Friday that it was considering refinancing some of its debt. Now, you're going to refinance debt right now? I don't know what they're paying now that they're going to refinance at a lower... I don't know. It's just like this engineering that Adam Aron continues to do at the company, which has helped it by and large in the eyes of investors. At some point, you gotta pay the piper.
I did loosely tie this. I like that Adam spent the weekend with AMC shareholders visiting. They watched Avatar in the movie theater. I wish more. I get it on Abbott. I get it. I know what he's trying to do. I know he's hyping it. But look, I wish more executives went out and dealt with the commoners. Maybe I should go out and buy one share of Ben Beth Beyond, and maybe new CEO Sue Gove would walk some stores with me. I mean, that would be great. Get out there. Go talk to your shareholders. Walk these stores. Tell us your transformation plan. I like what Adam's doing here. I really like it. I'll go watch a movie with him.
Well, they've got to remain extremely bullish on themselves, especially at a time where Cineworld is going through its own issues, which AMC then had to address at the midpoint of August, and talking about their liquidity ending the second quarter with more than $1 billion in liquidity, only thanks to significant amounts of cash raised in calendar years 2020 and 2021. And so it seems like even more of that cash is going to be necessary in the near term to also mitigate AMC from some of the similar macro issues that a Cineworld may be facing too.
Yeah. We are coming up on the opening bell, and I think people are going to be watching this bell really closely because we are opening up here with the Dow in a bear market. The S&P at its lowest since December of 2020, after having blown through the lows of the year that were reached back in June, with bond yields that have come down but are still at elevated levels. Stocks had fallen for 5 straight days. So given all of that, it feels like today is important, right?
No enthusiasm. Look at that. And
right.
Look, Jen Schonberger pointed this out to me on Slack, and she's right. We got late calls, like we mentioned, from BlackRock and Goldman, taking down their views on stocks. But when you see those calls, even though stocks are way down, it makes you nervous. Like, what are these guys
They're willing
bracing
to come
for?
out at this point and now say that.
Are we looking at another potential 10 to 15% downside? I read those calls as maybe that's potentially could happen.
Well, what's interesting in going into this session too, track real estate, energy, utilities, they were the biggest decliners yesterday. And then going into today, consumer staples, that can be an interesting one to keep an eye on. The only gainer yesterday in sector five.
Now we've got LiveWire ringing the opening bell on this Tuesday morning. LiveWire is the electric motorcycle spinoff from Harley Davidson, and we are going to be speaking a little bit later to Jochen Zeitz, who is the CEO of the company, right?
Yeah, it's weird because I used to cover Harley. I used to be a beat reporter way back when, and I remember when they launched this electric bike, and they were really pitching it as something that would change the bike industry. It hasn't happened yet because of the pricing. The pricing has been high. And this is cool technology, and I'm not seeing a lot of their competitors doing this, but still, it's that price point. You're a bike guy, you get it.
Yeah, when they brought it to the floor of the New York Stock Exchange pre-pandemic in the before times, they were looking at pricing of $29,000 it hit the market with. It's since continued to come down, and there is a larger question of course, what will be that average selling price that they see, given that they've got multiple tiers that they're going to be releasing all the way through fiscal year 2026. So we're going to discuss that with the CEO later on in the show.
And just a very, very quick note here. I'm looking at the sectors here out of the gate. And just as we saw the broad-based decline yesterday, we're seeing broad-based advance. Consumer discretionary, tech. I know you like the sector check, Brad.
Yeah.
So we're seeing up across the board here for all the different sectors within the S&P 500. I want to move on to Hertz here and what those shares are doing this morning as we talk about electrification. This is on that note. Up 2% after the car rental company announced it's teaming up with oil giant BP to install thousands of electric vehicle chargers in the U.S. Hertz has already had thousands of EVs available for rent at about 500 of its locations, and the company plans to have electric vehicles make up a quarter of its fleet by the end of 2024. Of course, BP isn't just an oil giant. It has a lot of BP branded gas stations as well. And so, that's where this partnership comes from. As we've talked about before, one of the things that's been holding back EV adoption to some extent is the lack of charging stations. So now we got some.
We're supposed to be critical of all companies. That just comes with our gig. But I have to say, I just like what Hertz is doing. They signed that deal with Tesla, signed a recent deal with General Motors, signed a deal with Polestar. Now they are laying the groundwork, I would argue, before many of their competitors for that EV future. And this BP deal makes a lot of sense,
It might be one of the most significant kind of peak to trough, or trough to peak, we should say, turnaround stories, because this is a company also that was staring down the face of bankruptcy in the depths of the pandemic, and at a time where they were waiting for so much of the demand to actually come back on the corporate travel side so that they would see even higher rates, not just of rentals, but at the spend level for so many of these consumers, even though you were seeing people opt for rental cars over the course of the pandemic versus some of the mass transportation options. So they still had that backdrop, but then it was about investing in the future, which they are squarely doing, and then eventually able to relist on the Nasdaq with ticker symbol HTZ, which we're tracking here. And so there is a huge kind of difference in the Hertz that we knew before and the Hertz now that's looking at where they can really woo that next generation of consumers that are going to continue to rent and looking for cleaner options to rent as well, given the different cities that they may be navigating, moving in and out of. And it's really going to be in that electric vehicle capacity.
Yeah, I was just out in San Francisco for the past 2 weeks, and you couldn't get a rental car. It was there was clearly, I passed a couple rental stations, there were no cars for availability, which really signaled to me maybe Hertz, even an Avis, maybe that might be sitting on some pretty good third quarters. But we're going to ask Stephen Scher about this in the 11 o'clock hour. He's the CEO, a relatively new CEO, took over earlier this year of Hertz, about his turnaround plan and this push to EVs.
Absolutely. Well, speaking of EVs, shares of Tesla, ticker symbol TSLA, they are moving higher today by about 3.8% this morning, following a report that the company is preparing for a high volume of deliveries that could close out a record quarter for the EV maker. In a memo, Tesla encouraged employees to provide, quote, additional support, end quote, to the end of quarter drive over the next few days. This is not the first time that we've heard it. Some type of internal memo saying, hey, we really need to go pedal to the metal on our deliveries and on our production to ensure that we can close out a strong quarter. Elon Musk has talked about production hell in the past, all the way to some of the most aggressive forms of making sure that everybody is all hands on deck and trying to hit some of the very, the large numbers that they've set forward. And they've continued to look at some of these records as not just, okay, let's set the record and then kind of set the ball down. It's how can we build on top of this? And they know that they need to do so because as you have more Ford and GM production capacity that comes online, Tesla maintaining the market share that they've been able to take on to this point in time is going to be amazingly critical because of the production capacity that GM, Ford, and all of the other behemoth automakers have exemplified for decades now. And so that's going to be extremely critical. That's why they're trying to just continue to build on some of the production and deliveries that they've been able to bring forward.
Real quick from here, before we get to our last mover here, fun fact, Tesla shares up about 17% in the past 3 months, the S&P 500 down 5%. So we're talking about bear markets all morning long. Interesting move here for Tesla. All right, shares of DoorDash also in focus after the food delivery service announced they are teaming up with JP Morgan to release a new credit card that will operate on MasterCard's network and is designed for those who use DoorDash and want to earn more where they are spending. The firms didn't disclose details on the annual fee, launch date, or perks. Beyond that, cardholders will be able to earn rewards on and off the DoorDash platform. Makes sense to me, guys.
Yeah, makes a lot of sense. And it also comes after, of course, there's been this vacuum, this space that's been left in the void from Uber's credit card. And that's not available anymore. And so now, as you've got kind of the Uber Eats side or the Uber side that had their credit card, that moved over to a Barclays MasterCard. Now DoorDash trying to really sweep in and get some of those potential card holders in this partnership with JP Morgan. We'll see if it ultimately drives more new memberships, more recurring purchases as well from their customer base.
It's hard to know if anything today is up because of specific news or if
Sure.
it's up because everything is up, right?
Tide.
Like we just showed DoorDash and Uber, and Uber's up more than DoorDash. So like, yeah, this is probably at the margin seen as good news. We'll see if it actually translates into higher sales for DoorDash. But everything's rebounding today.
I've gotten more into rewards programs. I don't know if you use them, but I've signed up to everything over the past month. I've determined if I'm dropping $50 on a meal on the Seamless, I want some rewards. I like this plan. I like it.
But that is also analogous with any time that we do see some type of consumer mindset pullback, or at least in the confidence of consumers, to look towards or lean into any of the rewards or loyalty perks that they would have gotten. Typically, I would have walked out of the store and been like, nah, you guys keep your rewards, keep your perks and everything like that. And I'll just let the points build up. But I think now is the time where consumers are looking to put some of those points, put some of those rewards to work as they're looking across where their spending is taking place and trying to get some type of either cash back, some type of either just product that, I walk into a Nike store and if I get something, I'm like, yeah, give me the free towel.
But
I want the free towel now.
remember, it's not free.
Nothing's free in this world.
It's not free.
Right?
Well, you're paying for it over time.
Well, and you're giving them an enormous amount of your personal information.
Can't you just let me enjoy
about
my
your spending
rewards? I just
patterns.
want my rewards from 7-Eleven. I got 5 cents off gas this weekend. It was so exciting. It was so exciting.
5 cents?
They got my email.
A gallon or 5
5
cents?
cents a gallon. It was so good.
All right.
They can have my email. It's fine. I just click out of the unsubscribe. I hit the unsubscribe.
You give them your fake email?
Yeah.
The fake email. I give them that
I gave
one.
my personal.
Oh, I like that trick.
Yeah.
Guys,
Guys,
5 cents off gas, dude. Come on.
I have so much trash in my inbox, though, from all of those rewards plans I've signed up for.
Yeah.
I don't know.
Move to promotions. Guys, coming up on the other side of this short break, it's been a bumpy ride for tech stocks. We're going to break down the road ahead on the other side of the break. Welcome back, everyone. It's been an ugly time for tech stocks with the Nasdaq 100 down over 30% so far this year. And tech stocks now coming off of their worst 2-week stretch since 2020. Yahoo Finance's Ali Garfinkel is here with us in studio with much more on tech. What are we keeping tabs on?
Yeah, it's great to see you, Brad. It's good to be here. You know, the Fed said there would be a lot of pain, and tech's in a lot of it. You know, the Nasdaq, we've actually seen the Nasdaq up about 2%, I think, as I was walking out, give or take, which feels pretty good, but down 30% year to date, right? That's a lot. This is a sector that was once seen as untouchable, right? You know, and it's also not part of this, like just one part of this sector, right? We're seeing social media, e-commerce, gig economy, you name it, right? They're all getting slammed. You know, Snap is one of the most notable cases of this, right? Sounds a whopping, I believe, 77% this year, which is rough, right? But the thing that's most striking to me is it's not just a name like Snap, right? We're seeing, you know, Apple, which once felt invulnerable, down, I believe, about 18% this year to date. You know, Google's parent Alphabet, it's declined about 30% year to date as of this morning. So that's kind of the lay of the land right now. It's not just one area, Brad. It's everybody. Everybody's getting hit.
Ali, it's so weird because we've talked to a lot of big tech executives the past 2 weeks, Mark Benioff, co-CEO, and his co-CEO as well, and you get the mood that demand is still pretty good. This move in these stocks just really seems to be because of fears of higher interest rates.
Absolutely. You know, I cannot stress enough that connection is, I think, very clear. You know, this is a sector, Brian, that I think has long thrived on low interest rates. It's long thrived on kind of this easy money. Growth investing is inherently optimistic and is what tech has been built on. So I think, you know, on some level, this has been promised, right? I think demand is still there. Remember, tech sells to the world, right? There is no shortage of people who are interested in the services of, say, a Salesforce or of an Apple, right? We're seeing that too, you know, with the Apple Watch Ultra, iPhone 14. But it's, you know, since Jackson Hole, this has been promised. Tech had already been on the receiving end, I think, of a lot of the pain we were seeing going into Jackson Hole at the end of August. So I think, yes, I think there's definitely not a problem with demand per se, but it is absolutely unequivocally connected to high interest rates.
But at the same time, we have to ask the question of, is there a disconnect? Like, are these executives
growth is still slowing,
not seeing what's out there?
It
right.
is slowing.
Yeah.
So maybe last year it's growing 30%, maybe sales are now growing 20 to 25%. That's not enough to support these multiples on these stocks.
Well, yeah, and especially if they're looking at still an environment where their growth strategy is hinging on any deal making and the easy money policies are being pulled back, then that makes the deal making harder to finance. That also means that on the FX side, where so many of these businesses are global in the tech sector, that they're going to hit with some of the foreign exchange headwinds that they've been hit with for now. It's going to be 2 quarters once we kind of wrap up this current quarter we're in too.
This is the thing experts have been saying and that I've started saying, you know, worldwide economic pain is pain for tech. Remember, it's not just the Fed. We're seeing interest rates go up across the world, right? Central banks everywhere. And, you know, advertisers are cutting spending. I do think interestingly, I think we should be looking towards earnings, right? I think we're going to see some misses. We'll see how bad those misses are. Remember, the growth that these companies have sustained over time, you know, that kind of thriving, maybe it shouldn't continue that way, right? We'll see how it all plays out, but I do think we're going to know more at earnings in a couple of weeks too.
Good to see you in person. Ali Garfinkel, thanks so much. All right, with the economy looking like it's heading south as interest rates rise and the stock market tanks, personal bankruptcy data may be worth watching carefully, points out the team at Arbor Data Science. Bankruptcy filings are well off their highs seen during the Great Recession, but have begun to tick higher in recent quarters, as our chart of the day shows right there. Coming up, global currency markets continue to be in flux as central banks raise interest rates. We'll serve up some analysis on what may be next on the currency front straight ahead.
Let's get a quick check on what's going on in markets here. We've had a lot of Fed speak today that we've been talking about. And the latest, James Bullard talking and saying we have a serious inflation problem in the U.S. and that the credibility of inflation targeting regime is at risk. This is in line with what we've heard in terms of sort of the hawkish or aggressive language that we've been getting from Fed members as of late. Markets unbowed because they have been so bowed over the past 5 sessions, I guess you could argue. The Nasdaq is now up around 2% here. We've also been watching currencies very closely. Of course, the U.S. dollar has been seeing strength compared to other currencies this year, although we're seeing a little bit of a reversal today. We've seen a weaker yen, a policy-hammered pound contributing to ripples in Forex overall. And the markets are now watching for how a downward shift in U.S. equity is set to hit currencies amidst all of this Fed speak. Joining us with more is Atsi Seth, who is Moody's Investor Service Managing Director. Atsi, good to see you. So we have been watching, obviously, a lot of turmoil occurring in the currency market. What should investors be bracing for now? It doesn't feel like necessarily that strengthening of the U.S. dollar is over.
No, I wouldn't say it is. And, the reason the dollar is strengthening, comes from multiple sources. The first is anytime you have uncertainty and geopolitical risks and macroeconomic uncertainty around the world, the dollar benefits as safe haven status. So that's one. The second is the Fed's been much more aggressive in hiking rates than its peer banks, whether it's the ECB or the Bank of Japan. So that's, again, strengthening the dollar. And then third, of course, you referenced the pound, where there's sort of idiosyncratic reasons for that particular currency to be very volatile in the last couple of days. So very, very many different reasons. And like you said, dollar strength is here for a while, as long as that interest rate differential remains, as long as uncertainty remains.
And so what is the reality of the continued impact of some of the kind of foreign exchange calculus that is taking place and the kind of longer term implications of that?
Sure. So if you think about an investor and you sort of separate the pound, where, again, the British government borrows in sterling. So the pound going up and down doesn't really affect the exchange rate, doesn't affect the borrowing cost. The yields might affect the borrowing cost, but the exchange rates don't. Whereas if you think about emerging markets around the world, wherever they borrow in US dollars, this sort of exchange rate turmoil can really increase borrowing costs for the governments, for the corporates in those emerging markets. So that's one thing from an investment perspective. The currency turmoil translates into debt repayment costs immediately. And that then affects actually the refinancing risk for those entities.
Atsi, one thing I was reminded about rereading the annual report for Nike, they of course report earnings later in the week, is big companies like Nike, they hedge against foreign currency risk. How should big companies be employing hedges in this environment? Because ultimately that may impact their profits and then by extension may impact their stock price.
Yeah, and it's particularly true. I think the data is now that about 30% of the largest U.S. companies earn, their revenues from outside the U.S. And so anytime the dollar strengthens as much as it has now, your revenues are going to be affected just because of exchange rate risk. And I think most companies that have that exposure are aware of this, and that the hedging is likely to be in place, if it isn't already, will be definitely in place. So I think most companies are aware of it. It is those companies that at the margin, even if you have 10% exposure and you don't think you need a hedge because, you're not expecting as much volatility, that's where the impact, when your currency is strengthening, by 5%, 10% against others, you feel impact even if you're at 10% revenues from outside.
So, Atsi, to put it all together, at a time when we are seeing global growth slowing, we are also seeing dollar strengthening, other currencies weakening, which has disadvantages for both sides. We're seeing credit costs climbing. It just seems like it's sort of pain piling on pain at a time of economic vulnerability.
Yes, it is. And, if there is one silver lining to your currency depreciating, it is that it makes your exports more attractive, and and that should help your growth as well. But your currency depreciating at a time when growth is, going down means that the sort of the export momentum is low anyway. So even that silver lining is slightly burnished, I would say. In a time of currency depreciation, those companies and countries that have deep domestic capital markets tend to benefit, because at least you can borrow in your own currency and you can finance yourself or refinance your debt at a time that your currency is depreciating. But yes, overall a sobering and sort of slightly negative picture for the next couple of quarters.
I like your quest for silver linings, though. I appreciate that always. Otzi, thank you so much for being here. Otzi Said, Moody's Investor Service Managing Director. Appreciate it. Well, coming up, Bed Bath & Beyond earnings. They're on top this week. Brian Sazi couldn't be more excited. We'll talk about it next.
Cool view, liked it.
Bed Bath & Beyond is set to report earnings after the bell on Thursday. The biggest question for investors, will the turnaround plan pay off? It's no surprise that that's where we find Brian Sazi's stake today. And I also think we won't be surprised by his answer to that question.
This is going to be a quick take because this is likely going to be a very disastrous quarter and an earnings day for Bed Bath & Beyond. A couple things here that I'm looking at is Bed Bath & Beyond shares down 35% over the past month into this report. First up, why this quarter will be awful. Couple bullets here. Let's fire them on up. First, stores are in disarray due to merchandise shifts. Here's a company trying to suck out all the private label merchandise that it tried to sell over the past year. Now bringing back the brand name merchandise. When you walk into these stores, there's just a mismatch of goods here, mismatched consumer message, ultimately that is impacting sales and profit margins. Next, home goods demand is weakening. RH reported just a couple weeks ago, they warned about a continued slowdown in home-related goods. Now, if RH is being impacted by this on the high end of the business, best believe that Bed Bath & Beyond on the much lower end is being impacted by the same trends. And then lastly here, of course, inflation. Bed Bath & Beyond, all home goods retailers continue to deal with a large amount of inflation in the supply chain. Now, breaking it down outside of just the broader things, a couple further bullet points, some top things to look at Bed Bath & Beyond specifically. As Julie mentioned, this is in fact I wouldn't even call it a turnaround play. This is a survival play. It is really yet to be determined if this company makes it deep into next year. And to that end, you want to look at gross profit margins will likely be down significantly year over year. Inventory, I would not be surprised if it is up significantly year over year because of the absolute plunge in sales. Cash levels, the company did finish raising $500 million recently, but you want to look at how much cash they burned through in the most recent quarter to see how much they will burn through in non-holiday periods for next year. And then lastly, guidance of any. I'd be shocked if you get any form of current quarter guidance or full year guidance from Bed Bath & Beyond, just given the volatile trends it's seeing in its business and as it tries to ultimately prevent itself from going out of business.
All right, so all of this at a time where we're seeing less bids on existing homes and of course, homes and sales there, that would dovetail into Bed Bath & Beyond's business because then foreseeably, people would be having to furnish those homes or just get some items from Bed Bath & Beyond to put in those homes. So what's the take?
Yeah, if you're trying to turn around a home goods retailer, now is not the environment when you have the 30-year mortgage touching, over 6%. But my take is this, if you are, the team is just great. I just love working with these folks. It's just absolutely amazing. Why bother? And the point there is this. You have the broader industry going against Bed Bath & Beyond. You have a company that is on life support here, and that could probably fall underwater. That would be like me going underwater right there. If you're inclined to play home goods, for whatever reason, and you want to ignore everything I'm telling you here, you look to stronger companies like a Williams-Sonoma. They've been doing a lot of good things. You look at RH. They, of course, warned a couple weeks ago, but still, fundamentally, they are a lot stronger than Bed Bath & Beyond.
Now I just want a nice hot bath.
Yeah.
I'm a bath guy. I like baths. They're cool. Yeah.
All right.
Too much? Whatever.
No, I've already got your Christmas gifts lined up then. Holiday gifts. I know exactly what I'm getting now.
Bath
Yes,
bomb.
done.
Give me the circle, like the balls, the bath balls.
Yeah, that's what
Okay.
Yeah, but you need the bubbles too. All right, so I'll get you
like bubbles.
the bubbles and the bath bomb. All right, done deal. Guys, coming up, we've got some breaking economic data on consumer confidence on the other side of this short break.
Welcome back to Yahoo Finance. I'm Brian Sazzi alongside Julie Hyman and Brad Smith. Investors are getting a little reprieve from the rapid selling that has descended on markets this month, notably a sloppy close on Monday. You're seeing all three major indices in the green at this point. But Julie, over to you. Some breaking news on the consumer confidence front.
Yeah, let's start with confidence here. Coming in better than estimated for September from the conference board at 108. The estimate was only 104.6. So maybe investors getting a little bit of actual good news today, not just this snapback that we're seeing in stocks. The present situation index going to 149.6, expectations still relatively depressed at 80.3, but an improvement month over month in all of the measures that we look at for consumer confidence. Really interesting there. Then we're looking at new home sales, which are a bit more trailing here. There we're looking at the August number, and there we saw also an unexpected gain to 685,000 on an annual pace. That's a gain of 28.8% on a month-over-month basis. So really interesting here to have these two economic data points coming in better than estimated. Now, of course, new home sales, the new home part of the market is the much smaller part of the market. Existing homes, a much bigger part, but nonetheless, interesting to see a little bit more positive news on that front as we get that consumer confidence as well.
You want to embrace some positives after the tough months for markets, but at least the markets are saying to just overlook some of this data and look what might be coming because of the rise in rates. I mean, you have the 30-year mortgage, around 6%. I mean, that is going to cause a major pullback in housing, and it already has.
Right. Well, and that's why perhaps the confidence number is all the more remarkable. And by the way, it's in line with what we got from University of Michigan also. That was also a more positive tenor to consumer confidence. Will that remain with the sell-off we've seen in stocks? We'll see, I guess, when we get next month's numbers. Brad, what are we seeing in the markets right now?
Yeah, as of right now, we're maintaining some of the early leads that we have amassed on this rebound Tuesday. Yesterday, we took an L, but today, maybe we bounce back. Let's take a look at the Dow Jones Industrial Average. Right now, up fractionally by about 0.7%. We'll round that off to tech-heavy Nasdaq Composite. You're also seeing that up. Let me switch this to a chart view just so you can see exactly where we've been trending. Of course, we've come off some of the early session highs right there that you've seen, but we're still holding on to about 1.1% in gains right now. And the S&P 500, taking a look at the average, you're also seeing that still in the green by about 0.8%. Again, a case of still being off of some of the highs that we had seen earlier on in today's session, but we'll continue to track that as we move on throughout the rest of today's trading activity. We've been keeping an eye on some of those sectors. Since you mentioned consumer confidence, let's go into the sectors and see exactly where things are performing right now. And there you're taking a look at XLY, consumer discretionary, particularly on this confidence side. You're still in that hold on to gains of about 1.25%. The only laggard right now in the 11 S&P 500 sectors is utilities. But also, just very briefly, want to take a look at some of the crypto stocks that we've been tracking on the day. With Bitcoin's move higher, continue to keep a close eye on names like Coinbase. Coinbase up by about 5%. This is one of the trending tickers on YahooFinance.com right now. So we're keeping a close eye on them, as well as tertiary players, Square, MicroStrategy as well. And so keep a close eye on some of those crypto names as we move on throughout the rest of today's trading session. Of course, crypto markets, they don't close though. Julie, I'll toss things on over to you.
Yep, even if those equities only trade in cash session during U.S. market hours. Let's stay with the market action and the sell-off that we've been seeing, in particular in some of those high beta tech names. Joining us now is Brent Winton, ARK Investment Chief Futurist, along with our Alexandra Semenova. And ARK has some news today and a new product. It's launching something called the ARK Venture Fund, which allows investors to invest in earlier stage venture capital funds. It's in partnership with a company called Titan. We'll get to that and that new product in a second. But Brett, I would be remiss if I didn't start on markets with you and what we are seeing here in the markets, because we obviously are seeing, have been seeing until today, a lot of pain within some of the types of stocks that are core holdings for you guys. Interest rates have really been a problem for tech shares. And I know that the head of ARK, Kathy Wood, has been out saying the Fed should not be as aggressive, but they don't seem to be changing their tune. So how much more pain do you think could be in store for these types of stocks with rates going higher?
Well, a lot's already been priced in. I think that it's very clear just from, the fact that you're asking these questions that it's a great time to invest in innovation. When people are focused on things like, what's the Fed going to do, when they are really scared by the macroeconomic environment, that's when you can find amazing innovation companies at fire sale prices. And we believe that from over the course of this decade, by the end of 2030, more than roughly two thirds of equity market capitalization will be attributable to the disruptive technologies that we invest in. It'll go from roughly 8 trillion in market cap to more than 200 trillion. And so we believe that for investors that take an appropriately long-term point of view with regards to equity markets, this is a great time to take advantage of these prices.
Brett, I want to shift gears a bit. There have been a series of recent personnel moves at ARK. Your appointment to chief futurist, Kathy handing over her portfolio manager role on 2 of the index funds. Can you talk a little bit about this and where ARK stands with a succession plan?
Sure. So it's very clear to us, looking at the technologies that we focus on, that the pace of innovation has picked up here. The underlying technology platforms that we're looking at are achieving product market fit faster. You can just look at the artificial intelligence space, where the image generation models, the natural language processing models, everything is happening at a massively accelerating rate. And so we see the scope of opportunities in the specific innovation platform verticals we focus on, cryptocurrency, AI, robotics, multiomics, and energy storage, as being actually larger than we had even anticipated 2 years ago. And so we are investing in our research platform by elevating some of the analysts inside the organization into directors in those specific verticals. And then I'm taking on the chief futurist role because it's never been more important to tune your longer term modeling, since the rate pace of innovation is pulling that longer term closer and closer to the present. Kathy, of course, is fully in charge of the organization, and she manages all the actively managed portfolios as portfolio manager. And I anticipate that she'll be doing so for the next 2 decades. I don't know, or longer. And so the reason for the restructuring was both to hire into our research organization. So we are hiring more associates. I encourage everybody who's passionate about technology to apply and to really lean into the opportunity that we see ahead of us and ahead for disruptive innovation, including on the venture side.
Brett, to a lot of the average investors that have lost a lot of money in the ARK Innovation ETF this year because they recognize a lot of the companies in the fund, what should they be doing right now?
Well, I mean, you can just look at what the investors have been doing, which I think is the right move, which is inflowing assets into the fund. We believe that there is an incredible disruptive technology tailwind here. We think that you're going
So, Brett, they should sit on losses.
Well, I can tell you what I'm doing, which is I am reinvesting, as in if you think of your portfolio as being composed of bonds, stocks, and then things with asymmetric skew, opportunities for asymmetric upside. When people are feeling fearful, that's the time to invest in those opportunities with asymmetric skew. If you're investing in equities, they could be up or down 20% in any given year. It's very hard to predict. And so the money that you put into equities should be money that you're not planning on taking out of the market a year or 2 from now. It should be 5+ year money. And I think there's no better opportunity in the marketplace than to be in innovation with that 5-year money. Moreover, I think that people are unintentionally short innovation within their core portfolios. Think of all of the problems that people are talking about happening in the world today. All of the issues with supply chain. Well, what's a company addressing supply chain? Flexport, which is in the venture portfolio. All of the issues with the energy. Well, wouldn't you rather own the premier electric vehicle manufacturer that's potentially going to deliver robotaxi within your portfolio? Innovation solves these problems. And so there's no better time to invest in those innovations than when people are feeling the friction and pain of this macroeconomic instability, and market participants are trying to run away from it as if their hair is on fire.
Brett, it was interesting. We had the head of Advent International come in recently, big private equity firm, and say this is one of the rare times that valuations are actually more attractive in the public market than in the private markets. So I'm curious about the timing of this launch of this venture capital product at a time when you have all kinds of strange disconnects between valuation and reality and unpredictability, et cetera.
Well, we think we have a great competitive advantage in the ARK Ventures portfolio. For one thing, we can play that arbitrage. In some technology areas, it's very clear to us that the private markets are underpriced relative to the public markets. And in other technology areas, we think that the opposite is true. And so since the inception of the firm, we've looked at that arbitrage and the way in which this portfolio is constructed, it can invest in private companies and will probably be majority invested in private companies, and it will be in public companies as well, playing that arbitrage. It also means that money that inflows into the portfolio doesn't sit in cash, but instead gets directly invested into innovation-focused equities. So you don't have the cash drag on your portfolio as you invest. And the other unique thing about this portfolio is it's available to pretty much everyone. One of the, I think, great unfairnesses in the market is that people are only allowed to invest in asymmetric private assets if they're already rich. And even if they're rich or they're an accredited investor, they have trouble getting allocations into, the top tier venture portfolios, and they have to put a huge slug of money in order to do so. Here with $500, you can invest in venture companies that ARK is providing access to. And we think we provide a great value proposition to investors and to the portfolio companies that we're going to invest in and support.
Brett, it's been a challenging year for ARK. Your flagship fund is down roughly 60% year to date. How are you going to convince investors who might be skeptical of ARK's performance to allocate to this new vehicle?
I think that all performance, particularly in the equity space, should be measured over a longer time horizon than the year-to-date performance. When we underwrite positions, both in the venture portfolio and in our public equity book, we do so on a 5-year forward basis. And there's a good reason for that. Markets are structurally short-term. There's lots of business and financial pressure that causes people to look quarter to quarter. And we do our underwriting of individual positions and the technologies themselves on essentially a business cycle basis. And I think that's the appropriate way to think about investing in equities. It's not, oh, am I going to get a return here in 1 year? Instead, it's how am I going to invest in the core franchises that are going to take advantage of the innovation tailwinds that are happening in this business cycle. I've never seen as large a disconnect between what's happening on the technology side, how fast things are moving, and what's happening on the market side, which suggests to me that this is an amazing opportunity to invest. The velocity on the one hand has to be reconciled with the market realization of the enterprise value creation that's going to occur.
All right, we'll leave it there. Brent Winton, ARK Investment Chief Futurist, good to see you, and good to see you as well. Yahoo Finance's Alexandra Semenova. All right, before I head to break, let's pull up shares of Twitter as the ticker remains hot in the Yahoo Finance ecosystem. Elon Musk and Twitter CEO Parag Agrawal did not depose in the ongoing litigation as scheduled on Monday in what marks another unusual twist heading into a potential court battle. The news lit a fire under Twitter into Monday's close on speculation the two would be announcing some form of agreement, but how this saga turns out is anyone's guess, says Wedbush analyst Dan Ives, quote, continue to believe there is a possibility behind the scenes. Both parties look to attempt negotiations before stepping into a court battle in a few weeks. Straight ahead, Biogen is set to pay $90 million in a prescription drug settlement. Julie is back with a rundown of today's top headlines.
Let's get you caught up on some other headlines we're watching right now. Hurricane Ian forecast to grow into a Category 4 hurricane before eventually hitting Florida. The storm currently moving over Cuba as a Category 3 storm. Much of Florida's western coast currently under a hurricane warning, as the storm expected to intensify as it moves into the Gulf of Mexico this afternoon. Governor Ron DeSantis declared a state of emergency over the weekend. Biogen will pay a $900 million settlement after a lawsuit alleged the company paid doctors to prescribe its drugs. The lawsuit, filed by a former employee, said Biogen would use kickbacks to encourage prescription of its multiple sclerosis drugs. Biogen will have to pay the federal government and 15 states involved in the case. The company denies any wrongdoing, but said it wants to resolve the litigation to focus on other priorities. Also dealing with legal troubles, Ford. It's asking for a new trial after a jury ruled the automaker will have to pay out $1.7 billion. That follows a rollover accident that killed 2 people. The suit alleged the truck's roof design was faulty and vulnerable to collapse in a rollover crash. Ford's new filing in Georgia claims it was not able to show evidence the truck was safe and the roof is stronger than others on the market. Ford says the state judge barred the automaker from defending itself. It goes on to say there were several other factors that led to the fatality that Ford was not able to use to bring forward in the prior trial. Saz?
Some crypto traders on Robinhood will get to take a crack at the platform's new no-fee crypto wallet. Joining us to explain what this means for crypto traders is Yahoo Finance's crypto reporter, David Hollerith. David.
Brian, this is a beta test for the new crypto wallet. And the difference between this wallet and past wallets is that it's a non-custodial wallet, which means customers control their private keys. Essentially, the funds aren't held on the Robinhood platform. Now, this is obviously interesting given that there have been recent bankruptcies, in which case customers have sort of lost their funds to a bankruptcy estate. So this is obviously something that's sort of considered an important feature for the security-minded in the crypto sector. Second to that point, this wallet will actually cover blockchain network transaction fees for users, which is interesting. It is something that looks sort of like a crypto-specific version of Robinhood's payment for order flow model. The key exception being that Robinhood will not receive rebates from market makers who will fill the orders for customers using the wallet by paying their transaction fees.
Yahoo Finance's own David Hollerith, thanks for continuing to track this big news coming out of Robinhood. Keep an eye on shares of HOOD moving on through the rest of the day. Also, everyone, coming up, housing prices spiked during the pandemic. A new study shows that remote work may be partially to blame there. We're going to share the details next. Housing prices skyrocketed during the pandemic, and the shift to remote work may be to blame. A new report from the Federal Reserve Bank of San Francisco found that housing prices shot up 24% in the 2 years ending November of 2021, with 60% of that rise correlated to the dramatic shift to remote work. Broadmark Realty Capital CEO Brian Ward joins us now. Brian, thanks for hopping on with us. Just to go a little bit further, the study had also found that the share of work being done from home, it's stabilized near 30% as of August 2022. And so with the stabilization at around 30%, even at a time where mortgage rates are increasing, where does that net out in terms of the net impact, perhaps, that remote work or working from home or hybrid work will have more long-term on the housing market?
Look, I'm not an expert on societal moves because of pandemics. Certainly there was a ton of abnormal demand that occurred over the last 2 years because of the pandemic. Whether that translates into long-term impacts on real estate, yet to be known for sure. I mean, we are starting to see a return to work. Different cities are having different results as a result, because of it. Let's see where it translates. We've seen these types of momentum moves in housing in past cycles. So I'm not yet convinced, but let's see what the next 2 years bring. One of the things, though, that I do think is important is there is still a long-term trend towards demand for housing. So even if we see short-term impacts here because of the cost of capital and broader economic moves because of what the Fed's doing on the Fed funds rate and the like, I still think, short-term you're going to see disruption, but long-term housing remains an interesting play. Whether or not remote work impacts that, difficult to say.
Brian, you guys do financing, so let's talk about financing trends right now. Have you guys been tightening your lending standards? Have you been tightening who you're going to give capital to in this kind of environment? That's effectively what the Fed wants. I'm curious if it's actually happening.
Yeah, it's tricky out there right now. So we are taking a more cautious approach to how we're making our investments. We're in a time where rates have moved incredibly quickly. I think there's a ton of inertia still in, for example, the housing discussion. I think that inertia will ultimately get disrupted, at least for the near term. Again, I'm bullish long term, but short term, I think it's going to be super tricky. So at Broadmark, we are starting to become more cautious. One of the advantages I should also mention, though, about Broadmark that I think is particularly compelling amongst publicly traded mortgage REITs, we are the lowest levered REIT by a long shot. We have about 8.5 cents of debt per every dollar of equity, compared to most REITs are in the $3 to $6 of debt per every dollar of equity. That's very purposeful on our part right now as we go into this part of the cycle. We really felt like it was really necessary to be unlevered and to really pick our battles very carefully. I think this market is in for more trouble, and coming in with this unlevered balance sheet, I think positions the business very interestingly for opportunity as we get into 2023 and 2024.
Brian, we've seen some real volatile moves in global currency markets and wealth overseas. What role is the international real estate shopper playing in U.S. markets right now?
Well, it feels to me like the international markets are way less of an influence today than they were 2 years ago. Obviously, Asian markets were a major player in that space. It feels like they've pulled back significantly. In my world, the foreign markets, the foreign investors really are not impacting us much at all.
Brian, just lastly, while we have you here, I mean, there is a net impact that rental prices have had to take on as well when you've got even more of the housing market that's seeing less bids or more buyer pressure. So with that in mind, on the rent side, because rents are also going up, that's going to continue to impact some of the discretionary spending, and it's going to be a long time before those rents start to come back down. How much of a net effect do you believe that what we're seeing in the housing market will have on some of the discretionary spending that consumers are comfortable with?
Well, I mean, renters are under real pressure right now, not only because of this inertia that I've talked about, but just core inflation. When you see the cost of gasoline, the cost of food moving the way that it has, that really starts to impact renters. And And I think, that elasticity to that ability to absorb price increases is waning quickly. And so I would envision, pressure starts to really build further in 2023. Let's see what happens with employment, with wage growth, because everything to me seems to be suggesting that renters can't absorb those types of price increases. And similarly, housing buyers can't either. And so hence why I'm a bit bearish right now.
Broadmark Realty Capital CEO Brian Ward, thank you so much. Great perspective on what's going on out there right now. Appreciate it. We have a bit of breaking news for you now. Alex Mashinsky, who is the chief executive and co-founder of Celsius Network, is resigning from the company. That's according to the Wall Street Journal. They are citing Mashinsky's law firm in that resignation letter, which the Journal is citing. I regret that my continued role as CEO has become an increasing distraction, he writes, and I'm very sorry about the difficult financial circumstances members of our community are facing. Those circumstances that he's referring to are the $4.7 billion that Celsius owes its clients. The company paused all withdrawals and filed for bankruptcy in July. And again, now Mashinsky, who has been under a lot of scrutiny, is stepping down. We'll bring you any further developments as we get them. Coming up, should younger people be getting COVID-19 boosters? Yahoo Finance senior healthcare reporter Anjali Kamlani has more on this with the guest next.
Welcome back to Yahoo Finance Live. I'm Anjali Kamlani. A new coronavirus booster is on its way, but with only a third of individuals opting to get this shot, the question being asked is who should be getting these new bivalent boosters? Joining us now to discuss is Dr. Paul Offit, Director of the Vaccine Education Center at Children's Hospital of Philadelphia. Dr. Offit, thank you so much for joining us and taking time to discuss this important topic. I know that there have been questions about these bivalent boosters and the lack of clinical data. So let's jump in on that point. Who is the most eligible and who should be really getting these boosters now?
Right. So I think when Omicron came into the United States, it was an immune evasive strain. So even if you'd been vaccinated or naturally infected, you could still get a mild infection, and for some, a severe infection. So the CDC did studies trying to answer the question, do you benefit from a third dose? And then later, do you benefit from a fourth dose? And what they found out was that you did, that there were groups of people who clearly benefited in terms of staying out of the hospital, staying out of the intensive care unit, and staying alive. But it wasn't everybody. The people that really benefited were, one, people who were older, meaning those over 75. Two is people who had serious health problems like chronic lung disease or chronic heart disease, or out of control type 1 diabetes, where even a mild illness could land them in the hospital. And then thirdly, the people who are immune compromised. So I think focusing on those three groups for this bivalent booster dose probably makes the most sense.
So we've already seen that there's been low uptake of boosters, and we know that right now those who are 12 and older are eligible for Pfizer, 18 and older for Moderna. We've got other age groups coming into the mix pretty shortly. So is it as advisable for them to get those boosters if they don't meet the criteria of a chronic patient or having any other underlying issues?
Right. So think if you're otherwise healthy, say less than 65 years of age and don't have any health problems, what a booster buys you is a few more months of protection against mild illness. So low risk, low reward.
So is it a situation where maybe someone who is considering it for their child, it's up to them if they want it, or is it because of other mitigation measures going away, maybe the vaccine is the best option right now?
In some ways, it's a matter of your style. In other words, some parents may argue, well, you know, if there's any benefit, then I'll accept what I think is a low risk. And others may argue, well, if there's any risk, I don't want to risk that if the benefit is so low. So I just don't think it's going to make much of an impact on otherwise healthy young people. We really should focus on those three groups who are most likely to benefit, because the goal of the vaccine is to protect against serious illness. It's the only reasonable goal. It's the only attainable goal. We're not going to be able to stop mild illness. We're not going to be able to stop transmission. And to try and do that with frequent boosters for otherwise people who are not likely to end up in the hospital, I think doesn't make a lot of sense.
What about in context of the newer variants coming along? Should we be getting boosters as a result of preparing against those?
Right, so that's a great question. I mean, right now, the strains that are circulating are BA4, BA5, so these subvariants of Omicron. They're clearly highly contagious. They clearly evade immunity in terms of protection against mild disease, but they don't evade immunity for protection against severe disease. I mean, if you're otherwise healthy and have had, frankly, say 3 doses, you're highly likely protected against severe disease. So then the only question is for how long? And I think ultimately the epidemiologists at the CDC and immunologists in academic centers are going to have to answer that question. For how long are we protected, say, after 3 doses if you're otherwise healthy? Because I think a booster dose makes sense for some as we approach the winter, but not everybody. And I think how long immunity lasts is going to be critical, because this virus is going to be with us for years, if not decades.
And so you're not saying no one should get these doses. It's just that certain groups are better off getting them than others. But then what about the clinical data part? We don't yet know sort of that efficacy level against not just the current variant, but also looking forward. Is that a concern?
Right. So when data were presented to our committee, the FDA Vaccine Advisory Committee, on June 28th, the companies did the studies the right way. They looked at people who'd gotten 3 doses of the current vaccine, the monovalent vaccine, with then a 4th dose of the monovalent vaccine or a 4th dose of this bivalent vaccine, except then it was BA1, the original Omicron. What they found was that there was an increase in neutralizing antibodies against the BA1 strain. We assume that will also translate to BA4, BA5, but the increase wasn't very big. I mean, it was 1.5 to 1.75 fold greater, which is not likely to be a clinically significant difference. I'd really like to see data showing that the bivalent vaccine is clearly and significantly better than the current monovalent vaccine, because the monovalent vaccine does protect against serious illness, which is the goal.
You've stirred up some controversy over having this opinion and sharing this insight. What do you think the future outlook is for COVID vaccines? Are we looking at annual shots, or are we still dealing with a situation where it's still pretty unpredictable?
I think we have to be very good at monitoring on a worldwide level whether there is a variant that arises that is resistant to protection against serious illness. So even if you've been vaccinated or naturally infected or both, it doesn't matter. You would still be at risk for severe disease. And when that happens, then we're starting all over again. That variant hasn't arisen yet, because even though these BA4, BA5 variants are resistant to protection against mild disease, for most, they aren't resistant to protection against severe disease. So we're still good in that sense. That original vaccine, which was made against the so-called Wuhan 1 strain, which was a strain that raised its head in China, has still worked well to protect against severe disease for all subsequent variants, Alpha, Delta, Omicron, the BA4, BA5. So that's good. And the reason that that's true is that protection against severe disease is mediated by something called T cells. And the regions recognized by T cells have remained fairly conserved across all those different strains. So that's good. If the virus drifts so far that you're not protected against severe disease, then we're talking about something else. But for right now, the current vaccines work well to protect you against severe illness.
Certainly a discussion, and some people still wrestling with this idea. Dr. Paul Offit, Director of the Vaccine Education Center at Children's Hospital of Philadelphia, thank you again for joining us today. Coming up, we'll speak with the CEO of Harley Davidson on the back of its electric motorcycle business spinoff on the other side of this break.
Harley Davidson established its e-bike business LiveWire in 2019. Now it has spun off the business into its own public company through a SPAC merger with AEA Bridges. The combined company now trades under the ticker symbol LVWR. Harley Davidson's CEO Jochen Zeitz joins us now. Good to see you as always. I know it was a lot of work getting to this point of the spinoff. Take us through why it was so important to do this and do it right now.
Why was it important to do it and do it right now? They're talking to you.
Hello. Yes.
Why was it important?
Jochen, why was it important that you did this transaction now?
Yeah, it was important to do what we're doing because it gives us strategic clarity on one side with Harley-Davidson and on the other side with LiveWire. We're targeting two different consumer segments, and LiveWire can now innovate in a space just like a new startup would do, and that gives us the focus and have the team in place to really be agile, be innovative, disruptive, and being the first all-electric motorcycle company on the New York Stock Exchange gives us the fuel and the power to do so.
Johan, hang with us, because I think we're having some audio issues. We want to make sure it's right. We know it's a big day for you and the Harley team. Just hang with us. We'll be right back.
Can you say that?
Big day for Harley-Davidson down at the New York Stock Exchange, where we find LiveWire, its electric vehicle division, now becoming a public company via a SPAC transaction. Still with us is Harley-Davidson CEO Johan Zeitz. Johan, good to see you again. I'm glad we got those audio problems touched up here. Take us through the transaction. Why was it so important for you to do it and do it now? What will it let you do inside of that core Harley division?
Well, LiveWire is now an all-electric motorcycle company and brand that is public at the New York Stock Exchange, and it really gives us the ability to innovate like a startup company, but with the support of Harley-Davidson. Harley-Davidson will provide the manufacturing, the supply chain, and a lot of the support that a startup will need to be successful. But on the other hand, we have a truly extraordinary management team that is focusing purely on the electrification of the motorcycle sport. We appeal to different consumer groups, but together we believe this is a winning formula.
Yeah, Johan, I noticed that there are going to be quite a few of the Harley-Davidson execs that are going to be sitting on the board of LiveWire, so still a lot of knowledge sharing that's going to be taking place there. You know, even as we're looking at some of the projected revenues versus the projected unit sales over about a 3-year stack at this point, it seems like this is really going to be based on the projection that new models are going to sell the best. A model in a $15,000 price range that's going to make it into the market. And so walk us through exactly where you expect some of that demand to build up for LiveWire and the pricing mechanisms that are going to need to be instituted.
Well, first of all, we already have one model, LiveWire 1, in the market that is selling quite well. It's a bike that sells for $22,700. But we've just introduced a new model. We're taking reservations as of today. It's called Del Mar. It's a product and a bike that's priced at $16,999. We have high expectations for it. We are just building our first production prototypes, and we think it's ready in the spring. So that is going to be a key price point for us to achieve our projections.
You've been a real turnaround agent since you took over, Johan. Where is Harley at in its overall turnaround? What inning you think?
Well, I think we are doing really well given the environment we are in. We did our rewire program during COVID when it started. We have our hardwire strategy. We are on track. Obviously, we are facing, just like everybody else, supply chain challenges, which are holding us back a little bit. But overall, our margins are up significantly. We believe we will have record EPS this year, and we are delivering on our strategy, despite the fact that the environment is certainly challenging and continues to be.
Has the semiconductor and supplier shortages and the challenges that you had mentioned on your most recent earnings call for Harley-Davidson, has that materially changed in either direction in order to retain some of the revenue forecasts that you've set forth?
Well, we think so. Obviously, we had an outage and a 2-week production shutdown in June, July, and we are now ramping up and trying to make up for the quantities that we've lost. You get used to this environment in a way. It's been around for a couple of years now, and daily challenges continue. We're seeing a slight improvement, certainly more stability on the semiconductor side, but we believe that the challenges will continue. But I think we have the right measures in place in order to cope with it.
I haven't heard a lot of folks come on and recently go in and say record anything, but it's good to hear those comments from you. In this environment, what type of bikes are people buying?
Well, what's great to see is that we're actually seeing growth in our core categories, in our core touring and cruiser categories, and that's nice to see after several years of declines. We are seeing the customer coming back to our touring bikes, so that's a real positive, especially in North America. So our core stronghold segments are the ones that we're wanting to grow in the next couple of years, and that's part of the strategy, and that's where the profitability of the company is, and where we are confident that with the new models that we're going to launch into the market in the coming years, we can grow our market share.
Why do you think the customer is going back to those touring bikes? I got a sense on your last earnings call, late July, that you're now starting to innovate more, whether it's the look of the tank or the horsepower of the bike.
Well, touring is our core category. Touring, cruiser, softail, trikes is where the big profitability of the business is. And while we've innovated also in the small cruiser segment with our Nightstar and have also gone successfully into the adventure touring market, we need to make sure that we're focusing on that. In addition to expanding the brand, we're growing our parts and accessories business, our apparel and licensing business. So we're broadening the brand to make it appealing for the rider, for existing riders, but also for new riders, for the female customer, and for those who love the Harley-Davidson brand.
I've walked into one of those stores in Soho, Johan, so I'm going to have to stop back in and see what on the merchandise side, what is new, what's fresh, and perhaps I can update my apparel here for on set as well. Just while we have you, I mean, I've grown up around two parents that have been on Harley-Davidson motorcycles in the past and have been proud owners. But even as we think about some of the pricing mechanisms that you've talked about in the most recent earnings call, what of the demand are you seeing right now remain intact following some of those pricing decisions, knowing that in the consumer right now, there is more consciousness about how much you're spending on these products?
Well, I can't really talk about the third quarter. At this point, we're in a quiet period, but if you go by what we said in our second quarter earnings call, we expect 5 to 10% revenue growth. We expect our operating income to be somewhere between 11 and 12%, and that's a pretty significant growth in the current environment.
Harley-Davidson CEO Johan Zeitz joining us this morning. Thanks so much for hopping on. Appreciate it.
Thank you.
Absolutely. All right, guys, switching gears. Let's take a look at some calls of the day. We're going to start things off with FedEx. Morgan Stanley slashing its price target on the company from $250 to $125, saying the shipping company has been reset following its profit warning. And shares are still holding on to gains. Of course, the broader market's higher here in the U.S. today, and FedEx still holding on to some slight gains. But I think more broadly, FedEx had really been one of these first companies, even prior to the next earnings season set to kick off, really giving that warning more macroeconomically, but globally as well. And that really kind of gives some type of glean into how business to business partnerships are faring, but also on the end consumer and the volumes that they're seeing start to decline as well.
Yeah, I mean, this definitely feels like an after-the-fact price cut, right? In this particular case, because the stock's already had its tumble of 29% since it came out and changed its forecast. So it's basically like an acknowledgement of reality, right?
Yeah. Well, I think the bottom line with FedEx is that they need to show, I think, investors a couple good quarters. And by that, I mean some form of stabilization in the top line. And then when it comes to expenses, that all these expenses, I think they promised they're going to cut close to $3 billion in costs last week. That needs to start showing up on the bottom line at some point.
Yeah, absolutely here.
All right, we're also watching shares of McDonald's after Citi said they see increasingly less favorable risk reward with the stock and lowered their price target from $275 to $246. I have a full story on this note now on the Yahoo Finance homepage, but I will say this, looks like a lot of focus by John Tower, he's been on with us a lot, the analyst that covers restaurants and McDonald's over at Citi, talking about risk to Europe. So a real slowdown in Europe, potentially hurting McDonald's business. Even though that U.S. might stay pretty well in terms of sales, Tower more concerned about the trends overseas and in the U.S. maybe not able to offset that.
It's a difference in taste profiles, too. I mean, McDonald's menu looks vastly different in different parts of the world. And so in acknowledging where they're even able at this point to navigate where they would need certain products, inventory to actually get through to their franchisees, that could be a far more materially detrimental process that they're wading through, but also even the pricing mechanisms for themselves to get those products and for the franchisees to have to figure out, all right, how do we just continue to pass that cost on to the consumer who's looking for some type of discount on the fast food items?
Yeah, I mean, we keep talking about the stronger dollar throughout the show.
Yeah.
This is an example where the stronger dollar is going to bite McDonald's. It's a double whammy.
I like that.
No, I didn't even mean to do that. It's a double whammy, right? On the one hand, you've got slowing economies around the globe. Are people going to be eating out less, even at a value proposition like McDonald's? And secondly, when they do bring those profits back home, they're worth less.
Less supersized profits for McDonald's.
There you
Don't
go.
supersize
All right, I'm looking at shares of Lucid. They are higher today. We're seeing a boost for a lot of the EV makers. Lucid in particular rising after Cantor Fitzgerald initiated coverage of the electric vehicle maker with an overweight rating, a $23 price target, which is well above where it is now. And the analysts there are saying the brand has greater efficiency, longer range, faster charging than its competition. They're also looking at the potential for the company to capture about 2% of the global EV market by 2026. Now, to me, that's pretty remarkable, given that Lucid is a luxury product. We're not talking about like a one-to-one with Tesla competition. We're talking about that this is a much higher end vehicle.
Yeah, I'm generally fascinated on how a Lucid, even a Polestar, fare during any form of recession. It would be their first recessions that they go through. What do bear markets mean for a super luxury purchase like Lucid? I suspect we're about to find out.
Yeah, I think it's amazing what Peter Rawlinson has been able to build over at Lucid, really taking so much of what he was able to engineer over at Tesla over to a new and launching a new brand in Lucid, and ultimately at the higher end, because knowing exactly where people had gravitated towards these products early on, Tesla had differentiated itself by saying, you know what, no, we're going to not go mass market out the gate. We're going to go luxury. That's exactly what Lucid did. And we're seeing continuously how some of the investors and the analysts are cozying up to that strategy from Peter Rawlinson and the team.
Indeed. We got to leave it there, folks. That does it for our reunited team here on this Tuesday. And we are seeing markets rise in celebration that we're back together. No, I'm just kidding. We are seeing markets down a little bit from their highs of the session, but still hanging on to gains. Coming up, Brian Sazzi is going to be back. He's going to join Akiko and Inez for a conversation with the CEO of Hertz, as we talked about after its deal with BP on charging stations. You don't want to miss that.
Welcome to Yahoo Finance Live. I'm Akiko Fujita in New York City.
And I'm Ines Ferre. Let's take a look at the markets right now. We are seeing all major averages in the green, gaining back the losses from yesterday for the most part. You're looking at the Nasdaq Composite up 1.6%, the S&P up more than 1%. If we take a look at Treasury yields, we are watching the 10-year Treasury note up 5 basis points to 3.92, 3.93%. So punching up towards that 4% level. And also taking a look at the U.S. dollar index, that's sitting below 114. Yesterday, the U.S. dollar punching above 114. So we are seeing the British pound stabilizing in Kiko. The dollar taking a pause from its surge. The DXY, the U.S. dollar index there, taking a bit of a pause.
Yeah, a bit of a relief there, although given where we ended yesterday, certainly far from it when you think about we're coming on the back of 5 straight days of declines. We saw the Dow enter bear market territory yesterday. Certainly, as you said, the bounce back we're seeing sort of giving back the losses that we saw from yesterday. But I think it's worth noting 2 numbers to put all of this in context. Since 1929, there have been 26 bear markets, 15 accompanied by a recession. And as we talk about what's happening, not just with the Fed, but also global central banks, that's still the top of mind, especially for a lot of investors who are saying, well, what does this all mean and where is the bottom when we look at where the markets have been?
That's right. And where we also have heard strategists say that the markets do not bottom as the Fed is increasing rates, or they have not seen markets bottom as the Fed continues to hike rates.
Yeah, and so let's talk about what we have heard from the Fed. We are keeping an eye on a slew of Fed speakers this week as the central bank's quest to bring down inflation persists. Chicago Fed president and known dove Charles Evans says it'll need to raise rates to a range between 4.5% and 4.75%. That is higher than his previous stance. Now, the Cleveland Fed's Loretta Mester says officials will need to keep restrictive policy in place for longer, given the current state of inflation. Meanwhile, Susan Collins of the Boston Fed saying the goal of a more modest slowdown, while challenging, is achievable. Worth highlighting what we heard from Charles Evans. This was in an interview that he gave to CNBC, where he also raised concerns about the Fed moving too fast, too quickly. And it's worth noting that because that has kind of been the concern here about this lagging indicator about, whether in fact we have seen the impact from those supersized hikes that we've seen from the Fed, and whether in fact the Fed should be moving even more aggressively when those impacts haven't necessarily taken hold yet.
Exactly. And so many experts that have told us that you won't see those impacts for somewhere between 6 to 9 months. So what type of impacts will these rate hikes that have already taken place have on the economy? And people point to the housing market. Look, we got new data for new home sales, unexpectedly increasing in August from the prior month, but still the median price for a new home dropping 6.3% month over month. We also saw a decelerating growth for home prices in the S&P CoreLogic Case-Shiller Index. So definitely seeing a slowdown when it comes to housing.
Well, and to your point on the number that we got from July in terms of home prices, that is the fastest decline that we have seen in terms of the rate of decline in history. Important to note that because, of course, as we look across the economy here, housing is sort of often the leading indicator of where things are headed. The Fed, of course, trying to cool things down a bit to bring down inflation, but also prevent it from a hard landing, which would lead to what some are worried is a prolonged recession.
Yeah, and definitely you see it in the industry. You hear from industry leaders in the housing market. And look, even Jerome Powell had said in the previous, after the previous meeting, I believe it was one of the speeches where he said a housing reset. So he used the word reset. So definitely the industry is expecting a slowdown in housing, and we are starting to see that. And to continue the market conversation, let's bring in Kamal Sri Kumar, president and founder of Sri Kumar Global Strategies. Kamal, thank you so much for joining us. You had wanted the Fed to increase rates by 125 basis points. Tell us, were you disappointed that the Fed did not raise rates by 125 basis points? And do you think that in the next meeting they should, and why?
You have several questions there. Let me start going one after the other. Yes, I am disappointed they did not raise by 125 basis points at the last meeting. I did not really expect them to. because in my mind, this is a relatively dovish Fed. So I had banked on about 75 basis points, which is what I got. The advantage of 125 basis points would have been that would have put the Fed way ahead of the market, ahead of the curve, and thereafter they will not have to do very much. This way around, they increased it by 75. The market is expecting another 75 in November, and the market will keep expecting that for a few more meetings. So in other words, by going so gradually, they are going to increase even more than they would have had they given one big move in last month.
Shri, with that said, we're just talking about the comments that we got from Chicago Fed President Charles Evans today about the concerns that many others have raised about moving too aggressively and too soon. Obviously, you weren't anticipating the 125 basis points. That's what you said they should be doing. But how big of a risk is that factor in terms of going too quickly when we haven't necessarily seen the Fed policy, or at least the intended impact of it, take hold yet?
The question is what we all mean by risk there, Akiko. And if you are talking about the risk of a recession, that risk is clearly there. There is nothing the Fed can do about it. They should have thought about it last year in 2021 when they were calling the inflation transitory. I wrote every month, every possible opportunity that they are totally wrong. Jerome Powell was out to lunch, and this inflation was going to be high and sustained. Having made a mistake there, having kept interest rates very low for too long a period of time, and even after he decided last November that inflation was not transitory, recall that the Fed did not start tightening until March of this year. Why did they wait another 4 or 5 months? They made the situation much worse. They are talking about home prices, and Secretary of Treasury Janet Yellen was talking about high home prices, putting them beyond the reach of first-time buyers. At the same time, the Federal Reserve was pushing up home prices by buying agency mortgage-backed securities. It is just incomprehensible to me. Do they have a big risk? Yes. Will there be a recession? Yes. It will also be a stagflation, because we are going to have a combination of recession with persistent high inflation rates like we did not see in the 1970s. So there is nothing the Fed can do. They can't reverse policy. If they want, they can go back in the time machine and probably go back 15 months and change the picture.
Shri, can you give us a sense of what the impacts of these rate hikes will have on institutions, on companies that are loaded with debt? I mean, the government has so much debt. It is such a different environment than the Paul Volcker environment, Paul Volcker being the Fed chairman that Chairman Powell has referenced so many times.
You are absolutely correct. There is a lot more debt today than we had in the 1970s, and that's going to make the situation much more difficult to handle, both for the US Treasury and for large corporations. What I think that would lead to is the fact that with the passage of time, you're going to have one or a few large companies which are unable to service obligations. And that in turn is going to cause what we say, quote unquote, credit event, meaning somebody cannot repay their debt, they default, and that in turn causes the Fed to switch. So if you are looking for interest rate increases to come to an end or to slow down, one way to do it is to have a credit event, and the Fed reacts to it by saying, now our job is to save the system. Think about 1998 with the long-term capital management, which unexpectedly collapsed in the aftermath of higher interest rates earlier in the decade. Think about 2008 when Lehman Brothers went down. And in each case, the monetary policy shifted to easing. And that is one of my scenarios as a possibility for the future. Another scenario would be that the very strong dollar in turn causes new issues of its own, because the strong dollar typically leads to financing issues. And if that happens, and if you have a coordinated manner of supporting the dollar, like we did with the Plaza Accord in 1985, that will be a turnaround in policy as well. So you need accidents to change it. It's not going to happen with the normal course of time.
Finally, Shri, while we're talking about the Fed right now, obviously we're in a global higher rate environment. A lot of focus being placed on the Bank of England, given what has played out over the last few days, the huge swing that we've seen in the pound, also on the back of these tax cuts that have been proposed by this new administration. Where do you think the BOE moves from here? And what is the risk of contagion of a misstep spilling across borders?
Your first question first, what do I think the Bank of England is going to do? They have already told us they are not going to do anything before the November meeting. And that is way too late. So what I expect is that you will again, even though today is a day of relative peace, both for the pound sterling as well as for UK bond yields, this peace is not going to last. This calm is not going to last too long. We are going to have one more turbulent move, if not more. And I am expecting an emergency rate hike on the part of the Bank of England. The risk of doing that is the following. If they raise interest rates by 100 or 150 basis points, that in turn has to work to support the pound, but more often than not in various countries, especially in developing economies, it gives rise to a new run on the currency. So people decide the government is very concerned about it. They're going to increase interest rates. So rather than buy pound sterling, I'm going to sell them. So that, I think, is what is the big risk. In terms of the policy itself, Akiko, I think the Bank of England and the Chancellor of the Exchequer have been working at cross purposes with each other. You almost wonder whether they belong to the same government or not. Earlier in the week, the Bank of England increased the interest rates by 50 basis points. And on Friday, the Chancellor of the Exchequer offset that with huge tax cuts. You cannot have one entity trying to cut aggregate demand when the other entity is trying to increase it.
Yeah.
That's going to end up in mass confusion. And that's what we saw take place Friday. And over the weekend, the Chancellor talked about further increases in terms of fiscal stimulus, possibly cutting taxes further. And you saw what happened yesterday. We had a renewed fall in the pound. So that's where we are.
Translation, more volatility to come. Kamal Shri Kumar, president and founder of Shri Kumar Global Strategies. Appreciate your time. Good to have you on today. Well, coming up, parting ways. The Bitcoin stocks correlation came crashing down yesterday, but will it take a much weaker dollar to give the crypto rally steam? Jared Blickery is going to be joining us with the breakdown on the other side.
it a bounce back Tuesday after a monumental Monday where stocks and bonds crashed, a day where crypto watchers will have also noticed Bitcoin breaking from its lockstep pattern with equities. So is this a signal the crypto correlation is ending? Jared Blickery is here with the details.
I don't know if you want to call it a comeback. I think, well, did you say bounce back? LL Cool J would have some words about this. Let me just focus on the price of Bitcoin, since I seem to be mangling my own joke here. Bitcoin, BTC, USD. I want to point something out, that USD, that is the US dollar. That's what that stands for. That is the denominator. So before we go on with our analysis, I want to show you what's been going on with the Dixie. That is the US dollar this year. Now, this is an index and it's heavily weighted towards the euro, but gives you an idea of the dollar strength. So when we had the US dollar appreciating, that bigger number in the denominator, Bitcoin up here, bigger number in the denominator, that means that Bitcoin, the price is going down. And that's what we have been seeing this year so far, along with a lot of other prices. Now, let's go back to this chart. This is a day chart. Here is a one-year chart, and we can see just after climbing to nearly 70,000, Bitcoin took a tumble and is hanging out by its lows here. Now, it has been in a very tightly defined trend channel going sideways for several months. Let's go 1, 2, 3, about 3.5 months. Not really doing a whole lot. Now, we did get some excitement when it went up to about 25, 26,000. That was in mid-August, but that was subsequently reversed. So essentially, we're in a trading range from 28,000 up to 25,000. That is the range. Now, we get some steam, we could head up to 30,000 and test this level here, but that hasn't happened yet. What's the news? Well, we got Jay Powell talking about it's going to take some time to get a central bank's digital currency in, but nevertheless, in the meantime, we have to do with the prices that we have, and until Bitcoin clears 25,000 decisively to the upside, we're just in a trading range here.
Okay, Jared, thanks so much for that. Worth picking up on those comments that we got from Jay Powell today, and as talking about the structural issues in the DeFi ecosystem, saying, this time around, we didn't necessarily see what we saw in terms of the pullback in the crypto space lead to financial or affect financial stability, but that's not going to be something that's going to last for very long. All of this, of course, happening as we continue to see this talk around regulation and what that looks like around the crypto space. But at least for today, when you look at where things have moved, I'm thinking back to the conversation we had with David Hollerith last week, where he said, watch the correlation here because things are starting to diverge in different ways, right? For a while, we were saying that so much of this was about Fed speak and that suddenly all the crypto traders were worried about the macro picture here. Things moving in a different direction when you think at where they were yesterday in relation to the broader equity space. Too early to call it that, but it's worth something, it's worth keeping a watch on.
Yeah, it may be early to call. I mean, you did have people, investors talking about whether crypto was an inflation hedge and such, and then we saw that it really wasn't necessarily. And the question is, will Bitcoin and other cryptocurrencies really surge once the Fed pivots, which doesn't seem to be anytime soon?
Okay, well, we'll continue to watch that, but let's turn now to the ongoing Twitter saga with Elon Musk. The unhappy marriage might look like it's headed for court, but rumors of a possible deal are sparking hopes, at least among Twitter investors. Here with more Yahoo Finance's Ali Garfinkel, who's in studio with us today. So we're obviously got a date, right, on the calendar in terms of where they're likely to head in court. What's the latest?
So we have fewer than 3 weeks to go before this date, Akiko, before this trial is scheduled, and both Musk and Twitter seem to be dragging their feet, right? Right now, my sources tell me this can kind of go one of two ways. One, things are taking a turn for the worse, or two, both sides could be headed towards a deal of some kind. Now, the latest today is that depositions for both Musk and Twitter CEO Parag Agrawal aren't happening this week as originally planned. Now, we're hearing that those depositions have been rescheduled, which is indicating that things are moving forward slowly but surely, but there is still a lot of hope, at least among investors, for an out-of-court settlement. We saw Twitter stock go up today on hopes for a deal, and we saw the same thing last week. So these latest developments aren't concrete, right? There's a lot we don't know, but my sources throughout the saga have kind of repeated the same thing to me about how it can play out, which is that ultimately Musk could be set to lose here either way. The question is just by how much. It's not necessarily likely that the court will make Musk go through with the deal in full, but Musk is probably liable for something here.
And do we have any idea how has this Musk and Twitter drama hit advertising for Twitter?
That's a great question, Inez. You know, it's not a secret that the digital advertising market has really been roiled in the recent months. It's rattling big tech specifically, and Twitter is absolutely included in that. You know, the difficult macroeconomic environment, inflation, high interest rates, war in Ukraine, it's definitely facilitated less spending in advertising. That said, we do know reportedly that advertisers are specifically moving away from Twitter due to this kind of volatility. They don't know what's going to happen with the platform, and they're not willing to spend money there.
Oh, interesting. Thank you so much, Yahoo Finance's Ali Garfinkel. And coming up, powering up, Hertz and BP team up for a new network of EV charging stations as the car rental group adds key infrastructure to a growing electric fleet. CEO Stephen Scherr joins us next. Stay with us.
Rental car giant Hertz has inked a deal with BP to develop a national network of electric vehicle charging stations in the U.S., powered by BP's EV charging business, BP Pulse. Hertz CEO Stephen Scherr joins us now to discuss the very latest alongside Yahoo Finance's Brian Sozzi. Stephen, great to talk to you. You have been moving very aggressively in expanding your EV fleet here. Tell me how this deal puts you in the position to reach that goal of 25% EVs by 2024.
Well, thank you, and thanks for having me. You've seen us make announcements over the last several months around electric vehicles that we are purchasing, whether it was Tesla, Polestar, General Motors. But now we're focused with this announcement on the infrastructure that's needed to really run this. And our ambition here is to partner with BP and eventually others to create a nationwide network in the United States where our customers will have seamless ability without any anxiety to get a charge on their car when and where they need. And it'll be seamless billing across. So Hertz will put its customers in a place where they can be indifferent to the network they use. We'll tie these together and make this a really seamless experience.
Stephen, I think the last time we talked with you, you just inked the deal with the team over at Polestar. The Tesla deal now in place, just inked a deal with General Motors too. How many electric cars are in the fleet currently? And let's say a year from now, how many will you have?
Well, we're at about 5% of our fleet right now that is electric, and our ambition is by the end of 2024 to be at about 25%, so a quarter of our fleet. I think that's a demonstrable step in the context of what we want to bring to our customers by way of a diverse set of choices on electric vehicles. But I think this announcement really begins to create a competitive edge for us, where not only will we have the cars, but we will have the infrastructure such that our customers can get out on the road, corporate, leisure, or rideshare, and really, take advantage of all that I think is really positive around electric vehicles broadly.
Stephen, I'm curious about the demand for these electric vehicles, for renting them, because I will tell you, back in May, I rented from Hertz, and I had the choice of renting a Tesla or a gas-powered car. I was going to Philadelphia for my college reunion, and it turns out that I went with a gas-powered car, even though the price was pretty comparable, because I was afraid of not having a charging station when I got to Philly. So the question is basically, what has the demand been like now that you have these Teslas to offer?
Well, first of all, thanks for your business as a customer of Hertz. Demand has been very, very solid. And remember, we're seeing demand not just among leisure travelers, but also among corporate travelers, where in fact corporations want their employees in an electric vehicle to satisfy some of their own carbon footprint objectives. And then, of course, we've been renting to Uber and Lyft as part of the ride-sharing network. So demand across all three has been very strong. You were obviously fortunate at a moment in the market when, in fact, pricing was indifferent as between the two. But now, given demand, we are getting premium pricing on electric vehicles. And I'd also point out, from a financial point of view for Hertz, the maintenance is appreciably lower on the electric vehicles. We're seeing it 40 to 50% lower, just given the nature of the car itself. But demand is there, very strong, and across all. I would point out, because you highlighted a point that people raise quite often, which is about the anxiety of charging. And obviously, our announcement with BP today, which will broaden out our network, will diffuse some of that anxiety. But what's interesting is that almost 50% of rentals at Hertz are driven a distance where the car would not need a single charge. And so I think the anxiety is understood, but it's early, it will dissipate. And what we're doing with BP will further help that effort.
Stephen, you mentioned the maintenance costs for EVs, certainly going to be lower, but there's also the question about what this means from an electricity cost standpoint. You've got the infrastructure in place with the chargers, but we've had issues play out where the chargers are there, but the grid can't necessarily support it when demand is at a peak. What does that planning look like as you move towards that target of 2024?
Well, you've hit on one of the real issues why engaging with BP is an important step. Not only are they going to build charging stations, mostly fast chargers, on our facilities, but we are going to use their energy management tools and software to sort of overcome exactly what it is that you're talking about, which is we know demand, we know where the cars are going. They have an ability to manage the electric grid and the direction and consumption of electricity in the context of charging. And I think that's a very powerful combination. And your question comes right at it, which is, this is not just about the physical infrastructure. It's about the ability of BP and ourselves to manage where cars can be charged based on what's available on the grid, across the network.
So, Stephen, a strong demand for Tesla electric vehicles. Inez is still searching maybe around for her next rental vehicle. She will find it, I'm sure. But what are you seeing in terms of holiday bookings? We're just a few minutes from I would say, peak season in many respects for a business like yours.
Yeah. Well, right now, leisure travel has been well past where we were in 19. Interestingly, corporate travel is coming back to kind of 80 to 90% of where we were. We see our backlog roughly 2 or 3 months in front of us. What is of note on the leisure side is, for the holiday period, we are seeing very strong, very early bookings into the United States by European travelers, mostly into Florida for the Christmas period. And that's running at about 2x what it was this time last year. And so bookings have been positive, out through the next couple of months. but equally to your question, in through the holiday period where it's proving quite strong.
Certainly hope that momentum keeps up. Stephen Scher, it's good to have you on today. Hertz CEO joining us there alongside our very own Brian Sazi.
Great.
Well, it's time now for a quick detour. This time our detour takes us far out into space. This is my favorite story of the day. A smashing success at NASA, with the space agency live streaming the moment their DART spacecraft slammed into the asteroid Dimorphos. Now, the collision entirely on purpose and planned since the spacecraft was launched in November last year. It's part of an experiment to see if it's feasible to change the trajectory of an asteroid if one threatens Earth in the future. NASA, meanwhile, taking a note from Aerosmith. Don't want to miss a thing. Had to put the reference in there, right?
Yeah.
They are watching the asteroid's trajectory for changes that will prove whether the experiment worked. And as I watched this live yesterday, what an exciting moment. I mean, worth noting, again, as we said in the reader there, this was intentional. This was not headed towards Earth, but it's the first time they've been able to divert the path of an asteroid. And at a time we've heard so much about potential asteroids maybe in the future headed towards our way.
Yeah, this is sci-fi material right here. I mean, you couldn't get more sci-fi than this, but definitely a great success. And knowing that if there is an asteroid heading towards Earth, NASA can take care of it.
Love the high fives all around. A lot of excitement yesterday.
That's right. Coming up, scorched earth, the soaring dollar pummeled oil as well as global FX yesterday, but supply curves ahead of Hurricane Ian are supporting prices today. We take a look at both those stories on the other side. Stay with us. Hurricane Ian has made landfall in Grand Cayman and western Cuba, delivering winds of up to 125 miles per hour and heavy rainfall. The exact path of the Category 3 storm is still uncertain, though parts of western Florida, including Tampa, are braced for a weather event that could dump 2 to 3 months of rainfall by Friday. And you're looking at live pictures of Key West, where the weather is starting to pick up there. More than 8 million people are in the warning zone, and Governor Ron DeSantis has declared a state of emergency.
Well, we're seeing crude oil bouncing back from its lows this morning following a steep decline due to waning demand and a strong U.S. dollar. Currently, oil still hovering around just under that $80 a barrel mark, well below its midsummer highs. Let's bring in RBC Capital Markets Managing Director of Global Energy and Digital Intelligence Strategy, Michael Tran. Mike, it's good to talk to you today. Let's start with that story that we're watching out of Florida right now. We've seen obviously Chevron and BP shut down some of their operations around the Gulf of Mexico. How significant an impact is the storm likely to have when you look at the broader oil markets?
Yeah, I think that the key idea here is hurricanes just simply are not as bullish as they used to be. And the reason why I say that is because I'm old enough to remember Hurricane Katrina in 2005, where it completely ravaged the Gulf Coast and offshore platforms were offline for significant periods of time. So that led to a supply crunch. This is a very different story with Hurricane Ian, in the sense that we have had evacuations from platforms just preemptively. But the key idea is you're going to resume normal operations in the next several days. And the reason why is because these platforms over the recent decades have been completely fortified. So as a function of that, the Gulf Coast is much more ready to take on the impact of storms now than was the case, call it 10, 15 years ago. I think a key factor to really think about here is if this hurricane really leads to stay-at-home measures, shelter-in-place measures, or widespread evacuation measures in places like Florida, this can actually lead to a greater demand destruction event than a supply destruction event.
And is that the case as far as what we're seeing with oil prices recently? I mean, is oil really reacting to demand destruction?
Well, I think what's really fascinating is that there's just so many different cross currents in the global oil market right now. I would say that the market is certainly really reacting to potential recessionary fears. In fact, I will share that I think the market right now is more concerned or more scared of Fed Chair Jerome Powell than the oil market is concerned about escalatory efforts with Vladimir Putin. I think what's really important right now is that there's a lot of different policy cross currents in the market driving the oil price either higher or lower. If you look at the 5 biggest major themes impacting oil price over the course of the past month, and likely to be the case over the course of the next month, you're looking at everything from OPEC policy. A month ago, we were talking about the likelihood or not of an Iranian nuclear deal. You look at Biden and his SPR program. You look at China's zero COVID policy. You throw the Fed in there. There's just so many different cross currents. And I think this has really led to a degree in the market of policy paralysis. The investors just simply don't know what to do with the energy tape. And as a function of that, liquidity in WTI is low, or the broad oil market is low. What you're also seeing is that positioning is also at the lowest point since early days of the pandemic when oil prices went negative. So this suggests that risk appetite is quite low right now, and the policy paralysis just continues to just really reign supreme in the oil market over the course of the past several months, and likely over the course of the next several weeks as well, at least until we are able to de-risk some of these policy factors.
You just alluded to the SPR release. Of course, that is coming to an end as far as we know come October. We're looking at reserves in the strategic petroleum reserves at levels we haven't seen since the 1980s. And the question is how quickly the U.S. government's going to move to refill the stock. What is your expectation on that front, and how is that likely to affect prices?
Yeah, this is a really great question that a lot of fundamental oil traders are really grappling with right now. When the Biden administration came out with SPR releases earlier this year, 180 million barrels, the largest SPR release we've ever seen in history. They provided a very clear timeline. It was roughly, you're going to do 180 million barrels over the next 6 months, which comes out to be about 1 million barrels per day. Now, the Biden administration has recently come out suggesting that they're going to refill SPR at some point in the future, and they've given rough guidelines in terms of the prices where they would start buying barrels. So this, in effect, should put somewhat of a soft floor into the market. The problem is that there's no real guidance in terms of real timelines. So we think that this is likely going to be a 2023 event. So there is going to be a tailwind of a lot of buying of barrels back into SPR, but timeline still remains quite fleeting at this point. And this is why the oil market is right now just really focusing on the downside and the recessionary fears that are just front and center at the moment.
Having said that, what does this mean for refined products and the price of refined products? Because we have seen gasoline prices go higher after they had been down consecutively for about 98 straight days. Heating oil as we go into the winter, and we know that we are exporting heating oil and diesel to Europe. So what can you tell us about the refined product space going forward?
I think what's really key here is you have seen gasoline prices come off quite substantially from the all-time record highs in retail pricing that we saw earlier this summer. The key idea here is we're still very, very tight from a global diesel or heating oil perspective. So gasoline generally wanes coming into the shoulder season. But diesel, as we go into, whether it be winter heating season in certain places like Europe, and we know that Europe is in for a bit of an energy crunch just given the war on Ukraine right now. But diesel prices continue to be quite strong on a global basis. Cracks are strong still across the globe, even though we've seen some weakness over recent months. I anticipate that there's a pretty strong floor not too far from here, just because on a global basis, there's still a shortage of enough refined product. Then also the key idea here is if we have shortages in certain parts of the world, like Europe, heading into winter, the key idea is, are we going to be able to get the right barrels to the right places at the right time? And we all think that's relatively easy to do sitting behind a desk, but logistically, it's always a nightmare. So whenever you have any sort of logistic bottlenecks in terms of getting barrels to the right places at the right point in time, that leads to a lot of potential volatility in oil prices. So I would anticipate that to really be the case heading into the winter.
Thank you so much, RBC Capital Markets Managing Director of Global Energy and Digital Intelligence Strategy, Michael Tran. Thank you. And coming up next, food for thought. Tempted to enter the crypto orbit after the bounce? You'll still have a sky-high dollar and a regulatory push to contend with. We hear from Binance's CEO, CZ, on the space next. Stay with us.
Welcome back to Yahoo Finance. I'm Jennifer Schonberger. Well, Bitcoin getting a bit of a bid in today's session, but the token and cryptocurrencies overall remaining largely under deep pressure as this cryptocurrency winter persists. Changpeng Zhao, CEO and founder of Binance, the world's largest cryptocurrency exchange, out exclusively with an op-ed on our website this morning, offering advice to investors and crypto firms on how to wade this crypto downturn. He joins me now in a Yahoo Finance exclusive. TZ, welcome back to the program. Thanks so much for being here.
Jennifer, thank you for having me.
Before we get to your op-ed, I want to kick off the interview with your reaction to U.S. Federal Reserve Chair Jay Powell's comments this morning on regulating crypto, in which he said basically monetary policy normalization, raising interest rates around the world, has revealed structural issues with decentralized finance that really needs to be regulated properly. He also pointed to some of the novel inventions replacing intermediaries with smart contracts that also require regulatory attention. Your reaction to that?
Yeah, so that's a very interesting problem to look at right now. The central banks give banks money to pay interest rates, etc. With crypto, there's no direct way to do that, and they are interest generating products. But they're actually in the U.S. I don't think that most of them are allowed. I think there's some regulatory agencies that have a view against that. So it'd be interesting to see which view plans out.
Building on that, back to that op-ed in terms of regulations, you write that advancing regulations for crypto goes against the ethos, but that it would foster innovation and establish trust. So my question is, if the U.S. were to come out with clear rules for regulating crypto, would that really help crypto blossom? Would we see more money funneled into the sector, advancing faster adoption, both on the part of corporations and consumers? And ultimately, does that lift us out of the crypto winter?
I think having regulations today definitely helps. Having regulatory clarity definitely helps. But it's not to say that all regulations could be good. We have to look at the specific regulation. For example, we've seen in other countries where they have a clear ban on crypto. That's one type of regulation. That's clearly not good. Whereas I don't believe that will be the case in the U.S. I think U.S. still has a very strong innovation, pro-innovation culture. So we have to look at it more specifically to see what it looks like. Bad regulations are bad, good regulations are good. But overall, though, I think given the level of sophistication and maturity of the U.S. regulators, I do believe that having regulatory clarity will actually ease adoption. There is a group of guys who got into crypto early. Many of them may be libertarians, anarchists, etc. They hate any kind of regulation. But I think for the mainstream users, the rest of the 90% or 95% of the users, that's still not in crypto yet. Having regulation will actually ease them into crypto.
SEC Chair Gensler has repeatedly asked crypto firms, crypto exchanges to come in and register with the commission. Is Binance in talks with the SEC to formally register? And how do you view the SEC's approach to regulating crypto? Would you like to see more specific rules specifically written for crypto?
Yeah, so my understanding is I think both Binance US and Binance.com are talking with all regulators pretty much at the same time. So I'm sure there are dialogues that's happening. I don't know the specific details of those dialogues. At the same time, I believe classifying all of crypto as security is probably a bit simplistic. There are many different types of cryptocurrencies. Some of them are closer to currencies. Some of them are closer to other asset types. I think we can clearly point to many different tokens that are clearly not securities. So I think that's a more simplistic view. It's very similar to the early days of internet. People ask, is internet a radio, a magazine, or something else? But internet has internet magazine, internet radio, and many other things. So I think we can't look at this technology as one asset class.
Crypto seems to be mounting a little bit of a comeback today, but again, largely remaining under pressure. How much of this crypto winter is going to persist based on the Federal Reserve's action? So long as the Fed is raising rates, does crypto remain under pressure, or is this more of a byproduct of the Bitcoin halving cycle, which can take some years to play out?
So to be honest, it's very hard to tell. There's a few different there's a few different logics here. One is when there's high interest rate, people should want to hold cash or deposit back into banks. But the bank interest rate is nothing comparable to crypto right now with staking yield generating products. And even like DeFi give you very good returns, much higher than the banks, and the money doesn't leave the DeFi protocol. So the other aspect is crypto is still very much correlated with the stock market, which is actually counterintuitive. But I guess today, most of the crypto traders are also stock traders. So when the stock market tanks and they want to hold cash, and then actually crypto market goes with it, in theory, they should be inversely correlated. But we have not seen that quite just yet. I think it will take a couple of years to see that. So so there's a few different aspects at play. It's very hard to predict in one shot, like what are the Fed policies going to affect crypto. And also, crypto is much more international. The user base for that is much more diverse. We see like in other continents like Africa, Latin America, they use it mainly for commerce, for payments, where they're not using that as an investment asset.
Unfortunately, we are out of time today. We do want to point viewers to our website, finance.yahoo.com, to read your comments in that op-ed, and also some news coming out, I know, from Binance on a new law enforcement training program. Unfortunately, we didn't have time to get to that today, but there's more on our website on that. And CZ, we want to thank you so much for your insight, and we hope to have you back again soon. That'll do us for right now. We'll send it back to commercial break. We'll be back shortly. Thanks.
Well, Netflix is gearing up to drop its Marilyn Monroe biopic, Blonde, as the platform leans on big budget movies to win the streaming wars. Let's bring in Yahoo Finance's Ali Cannell. Ali, let's talk about how this fits into that revamped film strategy.
Yeah, well, Netflix has really leaned on a strategy of, quote, fewer and better titles, specifically when we talk about their movies. Blonde, of course, has been making waves in the headlines. There's been buzz about Oscars potentially, but a big question is whether or not big budget films like Blonde are worth the sky high production costs, especially since Netflix has been so focused on profitability. The Gray Man, for example, was the last big budget film that Netflix released $200 million to produce. An A-list cast. There's already a sequel in the works, but it spent just 8 days on the Netflix top 10 list. In fact, viewership dropped a whopping 60% in week 2, and then by another 46% in week 3. You can see a lot of those other films also following similar patterns. Huge opening in that first week, and then a very steep drop off the rest of the month. Now, all that being said, The Gray Man still racked up a significant amount of views, 245 million hours of viewing time in its first 28 days, the number 4 most watched Netflix original, but that probably is still a disappointment for Netflix considering that $200 million budget. So I think a bigger question that investors and analysts are asking is Netflix leaving money on the table by not releasing a film like that in theaters first? And that's something that they're going to have to address and deal with. We'll see if Blonde follows that similar pattern and whether or not Netflix will update that strategy as a result.
Yeah, the bar certainly a higher one, especially given some of the slowdown that we've seen in subscriber numbers and the expectation of profitability. Ali Canal, as always, thanks so much for that. Let's do a final check of the markets before we let you go. A bit of a split picture here, but really pretty flat when you consider where we were yesterday. The Dow is down 34 points. The S&P 500 down about 1.5. They're trading pretty flat, as is the Nasdaq. I guess we'll say investors will take it after the day that we saw yesterday.
Yeah, though it seems like we are reversing course pretty quickly. The 10-year note, I should note also, is up about 7 basis points at 3.95%. So a lot happening in the bond market as well.
Okay, that does it for Inez and I in this hour. Much more to come here on Yahoo Finance Live. Keep it right here.
The markets and the Fed and surround sound. Let's bring in Carson Group Chief Market Strategist Ryan Dietrich. Ryan, great to have you here with us this morning. All right, first and foremost, we just got to get your perspective on what we've been discussing more broadly here in the Fed and its comfortability in kind of spurring a recession and how deep long or protracted do you believe that recession could be?
You guys want to start off with something a little easier? No, good morning. Thanks for having me. I mean, listen, I think the Fed is hinting that they'd be okay with a mild recession. And although we don't think we're in a recession right now, you don't have 3.5 million jobs created to be in a recession, in our opinion. The truth is, again, things are clearly slowing. We all get that, right? So 9 months from now, we might be in a mild recession. You look at it, though, historically, the Fed hikes until the Fed's funds rate's above CPI. Right now, that's 3.25 versus 8.3. So there's still some room there. We still think inflation is going to come down fairly quickly. I know we had that sticky CPI number, but producer levels, prices paid, chicken wings. There are some things really coming down on the inflation front. But the truth, again, the Fed's seen the history books. Maybe last comment. The Fed's seen the history books, right? It took a double dip recession in the early 80s to stop that runaway inflation. We don't think we're going to necessarily need that, but they know you might need something besides just hiking rates, and that could be drastically slowing the economy, maybe to a mild recession, and that could be kind of what stops inflation. And honestly, guys, the stock market's pricing in a mild recession as we speak, down 24%, maybe making new lows for the year on the S&P as we speak today. That's pricing in at least a mild recession. So from an investments point of view, there are potentially some positives.
Ryan, thanks for the hot tip on chicken wings. Though, I may not be able to open a home, but I'm going to go buy those in low and just store them in my freezer in my plate, because that makes a lot of sense to me. But look, I'll push back on this. I think this market is starting to now price in more than a mild recession. We are looking at potential testing of the June 16th lows on the S&P 500 around 36, let's say 3,600, and then the floodgates open after that. You can see the S&P go below 3,300. Is that a reasonable scenario if we start getting some really bad economic data?
If we start getting really bad economic data, it's possible. And let's not forget, 3,500 is actually a 50% retracement of the entire bull market. So that's a really big kind of number to be aware of, 3,500. But again, you just talked about it, Brian. Like, it's pricing in some bad stuff, right? Look at that AAII sentiment poll. I know you guys talked about it. More than 60% bears last week, only 4 times in history. All right, near major market lows, like every time that's happened. So again, everyone's thinking all this bad stuff's out there, and trust me, we're aware it is. When you look at bonds down 14% for the year and stocks in a bear market, this is like the worst year for a 60-40 portfolio. Only once was it worse, in 2008, when stocks dropped 40%. So it's a terrible year for investors. At the same time, so much bad stuff is being priced in. When you look at all these sentiment polls and things, I would like to see the VIX a little higher. I would like to see put the call ratios a little bit higher. But again, last comment, October's a bear market killer, right? 84, 94, 98, 2011. For whatever reason, October tends to be a bear market killer. We'd just be open to the idea that could be happening potentially once again this October, with a tad more weakness. And then, that seasonal strength around a midterm election into the third year of a presidential cycle, especially under a first-term president. That third year usually does really well. We think, investors should be thinking about that at least.
Is a defensive portfolio the only play right now? Is there some other type of strategy that investors can employ?
Yeah, well, good point. I mean, with stocks down this much, we think, a little defensive, your utilities and staples, but honestly, start looking at some of those cyclical areas, right? Your financials and industrials. I mean, I know they're down a lot and they've underperformed, but honestly, financials or industrials are starting to do a little bit better. So we think kind of that barbelled approach right here for an investor makes sense, because if you go all in defensive right now, it's what everybody else is kind of doing. And again, look what happened last week, right? Energy's been doing awesome. Energy was down 9% last week, right? I think one of the things you need for a major low is to shoot everybody. And honestly, now that they're shooting energy and some of the previous leaders, that could be a good thing to finally make some type of a major market low here.
At what point, Ryan, do you jump in and buy big cap tech? I mentioned Apple at the top of the show. It is now leading this market low. Microsoft down over 11% in the past month. Apple down 9%. These are huge declines in household names of companies that are still showing double-digit sales and profit growth, impressive cash positions. Is now the time to jump in, even under the assumption that maybe we lose another 5% here?
Mm-hmm. Yeah, I'll tell you what, Brian, we don't really like large cap tech here. We're still underweight that group. We think some other areas, we like small caps, actually. I mean, we think small caps could do a little better than large caps going forward. At the same time, for somebody who's looking at a 1 to 2 to even longer term horizon, there are some incredible companies you just kind of talked about there, making a lot of money that aren't going anywhere. That again, if everybody's thinking alike, somebody isn't thinking. That's the quote I like to use a lot from Patton. A lot of people don't want to touch anything here. So maybe there's some opportunity, and some of those could still do fairly well longer term. We're not too warm and fuzzy tech in general here, honestly, still.
Carson Group Chief Market Strategist Ryan Dietrich. Ryan, always a pleasure to get some of your insights, especially kicking off a new trading week here. Thanks.
Thanks, guys.
Dallas Cowboys owner Jerry Jones has taken his investment strategies outside of the world of football, seeing a more than 300% return on his now 182.2 shares of natural gas producer Comstock Resources since 2018. Jerry Jones and Comstock Chairman and CEO Jay Allison join us now live from the New York Stock Exchange. Yahoo Finance's Josh Schaefer is also with us. Good morning to you both. Jerry, I'll start with you. Why did you make this investment in 2018, and how confident are you in the outlook for the company moving forward?
Well, I deliberately went to where the gas was, the Haynesville gas. Comstock had drilled more Haynesville gas wells than anyone. They had initiated the play when it first started years earlier. But it was an opportunity in my mind to get involved with the ability to export natural gas liquids, LNG, the ability to do that. Then I wanted to saddle up with the people that knew it the best in the Haynesville. I made an investment that initially of about $600 million, and then I came in behind that with an investment of about $475 million. The more I found out about Comstock, the more I wanted to put in it.
Jay, it's been a good year in the energy sector. I mean, it's been the best outperforming sector at this point in time. And so even as you think about the gains that the share price may have seen, how do you think about the future moving forward from here, and where you may have to continue to invest in order to grow out the business even further?
Well, I'll speak as an investor. The Comstock can differentiate itself from the idea of a energy company. Comstock has very unique reserves. They are, the acreage is where the ethos of the people that do the work, they're generational in being in the oil and gas business. The laws let you put in pipelines, and they let you take it a short distance to the Gulf, where you want the gas to be. And so we have a huge butane tank, if you will, of supplies that frankly, in and of itself, could knock a big dent in what you're selling, what Germany needs. It's that kind of size. So I'm excited about where we are in this current time of investors looking at a natural gas company, where its place is in the energy world, and I'm excited about our management team we have at Comstock.
Jay, you've spent a lot of time in this industry, and we still might see economic growth slow into the winter season. Perhaps we might already be in a recession. Who knows? What does that mean for the outlook for natural gas prices?
Well, I'm not going to get into, because I don't go there, really in analyzing seasonal trends. I will say this, that we all understand that weather and climate help influence gas prices. And we understand aberrations, catastrophes, those kinds of things. But I look at this long term. These reserves that Comstock has can make it go at $2 gas. We can make it go at the different ranges of whatever gas is. It will, though, be there without debt, without loading the company down with debt, so that we will be able to manage through low prices so that you can basically be viable and have the gas for the complete spectrum of demand. Gas is about delivery, not about reserves. It's about delivery. And Comstock is in the place to take huge reserves and get it delivered to the market at the lowest cost in the industry. That's why I'm here.
You know, when Jerry called, he asked if we drill a well, can we take it to sales? And if LNG has legs, can we deliver it to the LNG shippers? And then, do we have inventory? I think the one thing that the M&A world is doing, they had to really grow, even recently, because they had a lack of inventory. If you look at what Jerry did in 2018, he consolidated his private company into Comstock, and then we were aggressive in M&A in 2019. That's when gas was $2 and $3. To be aggressive in M&A when gas is $6, $7, $8, $9, we think goes against our plan. So what we have today, we've got the lowest cost producer with the highest margins, with we think the greatest inventory. We drill about 80 wells a year. We turn about 58 of those to sales every year. So we have about 25 years worth of inventory. So it's pristine and the cost structure is extremely low. I think we got the lowest G&A in the whole sector. And if you just look at sheer cost, you know, it takes us $1 to run the company. And our historic finding cost for 3 years, our numbers, is about $1 to find and develop these reserves. So anything over $2 is a profit for Comstock. Our EBITDAX margins, if you compare them to other oil companies and or gas companies, they're 85%. I mean, these are the highest of the high. So that's what we have. And you know, gas prices will fluctuate. But I do see natural gas, it's taken a detour from where oil is, and it's probably trading at a 10-to-1 now ratio. So it's important. I think it'll be important in the future. They predict by 2023 that the demand for natural gas will probably be greater than oil. So we'll see. As Jerry said, we're sitting on some tremendous gas reserves, and most of that is held by production. 85% of what we own, we do not have to drill. So you put a rig or two out there if things get really tough, and we're still in tremendous shape, particularly
Well,
the balance
and Jay,
sheet.
I want to interrupt you because he and 2 or 3 other of his management team just bought $5 million worth of stock in the last few days. Now, of course, I sit here as someone who's put over $1 billion in the stock in this company. I've always believed put your money where your mouth is. And what you're seeing is the people that are in the weeds, the people that are seeing the future both on a microscopic level as well as a broad picture are putting their money into Comstock.
So,
well,
Jerry,
to Jerry's point,
just to jump in very quickly, Jay.
$5 or $6.
Yeah.
Yes.
Just to jump in very quickly, Jay, I just wanted to follow up on what Jerry just said. Jerry, would you be willing to take more of a stake in Comstock than you already have? And what threshold would that look like to you?
Absolutely. I have been ready to buy more of Comstock since the day I got here. We manage that way if necessary. What's ended up happening, though, is that we have delevered our balance sheet, and because of the gas prices, and we are sitting here today internally. And so we really can develop these reserves. We can figuratively double our gas production and do it all internally. We don't have to go do issue stock. We don't have to go borrow a lot of money. We can do it internally, and that's what makes Comstock so special.
And Jerry, we
well,
can't have you here without asking.
Sorry, Jay. I was going to cut in and ask Jerry a little bit about football here. I wanted to ask you a little bit about the Cowboys.
Football.
We know you're here in New York because you got the Giants game tonight as well. The Cowboys are playing the Giants. That game's going to be on ESPN, of course, Monday Night Football. But there has been a lot of talk about what Amazon's doing with Thursday Night Football. I'm curious just what you make of Amazon's interest in the NFL, and what does that mean for the NFL as a whole to have these big tech giants that now want to come and get involved with you guys with Amazon and maybe even potentially Apple down the road?
Well, I think Thursday night's audience was epic. Frankly, deserves special notice by a lot of factions. Those numbers were surprising to me, and I think they're a picture of what's to come. I don't believe there's any question that the game has the interest and has the eyeballs. We're at the right time of the year when you want the decision makers in front of the screens in the fourth quarter. I think all of that's alive and well. Frankly, the picture for the National Football League in the entire time I've been associated with it has never been better because of the continued interest. And then again, you look at last night. Look at how these games turned out last night. 6 or 7 of them decided just with minute to go or with a point difference, that type of thing. All of this points to real eyeball interest, and that's a big deal for the NFL.
And Jerry, you say the picture's never been better, right? We've talked a lot about valuations on this program as teams have been sold. The Broncos were sold for $4.5 billion. I know your valuation, according to Forbes, has basically doubled in the last 5 years at about $8 billion now. I mean, what do you make of valuations? Do you think those numbers are the right numbers? Do you think they're going to keep going up? Do you think the Cowboys are worth more than $8 billion anyway?
Well, I know that I wouldn't sell the Cowboys for 10. That is, I'll book it. I would not. Of course, I'm not interested in selling the Cowboys. And therein lies a part of the answer. You have limited owners. You have limited teams that might ever be available. And you have outstanding growth in those franchises. And then you have the fact that I bought the Cowboys not to make money at all. I had a little money. I'd done it in the gas business. I had a little money, but what I wanted to do was coach football. I never thought that I could be involved in something that would have economic viability. The fact that it does have economic viability and has for the last 30 years, beyond anything I could have ever imagined, is just a major plus. So I think there is a future of values that will exceed what Denver went for sure.
Is there another big player you'd like to add to the team, Jerry? I asked this from a Philadelphia Eagles fan perspective. I just want to sense a landscape of the competition out there.
Well, I'm impressed with the Eagles team, period. And
thank you, Jerry.
I love the way the quarterback has evolved. And I'll tell you this right now, this is really going to seem funny to you. I actually like Eagle fans because they are so passionate, they're so mad at it, and it just tickles me to death to be involved with them up there. And they're all frauds because they're pretty good people behind that hate that they have when they get on the football field.
Yeah, I had to bring some of that Eagles energy to New York. That's why I moved up here, Jerry. Great to see you up here in New York as well at the New York Stock Exchange. I know you'll probably be at the game later on today, too, between the Cowboys and the Giants. Also, thanks to Jay Allison, Comstock Chairman and CEO, alongside Yahoo Finance's Josh Schaefer. Appreciate the conversation this morning.
With week 3 of the NFL season all but in the books, let's bring in Needham Company Managing Director Bernie McTernan to break down the betting landscape thus far into the football season. Also with us is Yahoo Finance's Josh Schaefer. Bernie, a lot of some big upsets over the weekend. A lot of people maybe counting their losses.
Yeah. Well, so we estimate that was probably a normal hold for the sports books this past weekend. Wasn't necessarily great for my wallet, but yeah, with the Bills, with two of the most liked team, the Bills and the Chiefs going down. But overall, we think it was a normal hold for the sports book. The other thing that's hitting as well too is the unders. That's been hitting at a higher than 60% rate, actually pretty similar to last year. But what we focus on and what we think matters the most are the 5 highest spreads. And back to week 1, over the first 3 weeks, the favorite has won 3 or 4 of those, depending on the week. And so that generally points to a normal hold for the operators. So that's in line with DraftKings guidance. And then if we look at a company like Genius Sports, it's actually ahead of or better what they expected. They assumed a hold similar to last year, which was a headwind for the industry. Genius, as you guys have been talking about, is dealing with FX headwinds, but at least the game outcomes are better than what's contemplated in their guidance.
And as far as other numbers that you're looking at is where gamblers are going, right, and what platforms they're using. I know you pointed out in your most recent note that DraftKings have been the most popular app on iOS. I was curious if that was surprising at all compared to maybe FanDuel, which I think we understand has more market share nationwide. Is it surprising at all to see DraftKings there? What do you think's driving that?
Yeah, no, it's pretty consistent with last year. If you look at the iOS App Store, DraftKings and FanDuel are really in that top tier together, really jockeying for that 1 and 2 spot for the top sportsbooks app in the sportsbook section of the App Store. And then MGM is really in the 3rd category, and that's followed by Barstool and Caesars below it. And that really held true for most of last year too. The one difference was when New York launched and Caesars made a big marketing promotion to really try to take share in New York. Caesars actually went up to the #1 app, but that was short-lived. If you look at after the NFL season and the NFL preseason, they went back to that number 4 or 5 range where they are currently. So it really seems to be shaping up the way it was last year. And that's a big investor question we get, is what the long-term market share of this industry looks like. And we continue to think DraftKings, one of the reasons why we have a buy rating on the stock is that we think that just their scale begets better technology, which could be a differentiating factor and a reason why customers keep returning to the platform.
And when we talk about the stocks themselves, we like to talk about spending, right? And the promotions that these different companies are kind of putting out there. Is DraftKings promoting more than, say, a FanDuel? How are you evaluating the promotions through the first couple weeks? And who's maybe promoting the most, and how's that kind of driving the market share? Yeah,
look, it's a great question. We have $800 million of an EBITDA loss this year for DraftKings, that peaking in the 3rd quarter with over a $300 million loss. And a lot of that spending is going on sales and marketing. In general, the promotional environment seems a little bit less intense than last year, especially because of the Caesars, what I spoke about before, how they were really intense with the New York launch and then faded back. Really, but DraftKings and FanDuel, they've been saying that they're going to keep spending against their thresholds. So with DraftKings, that's a 2 to 3 year customer payback on gross margin. And they, both of those companies haven't backed away in terms of how much they think they're willing to spend. DraftKings thinks they have enough cash on their balance sheet to be investing and acquire customers in the same manner they are now to eventually get to profitability in 4Q of 23. And we think full year profitability in fiscal 24. So no real change from the top two. It's just more Caesars. I think we're seeing them back off a little bit relative to the peaks of last year.
Finally, Bernie, from an investment standpoint, where do you see the biggest upside? I mean, which one of these companies offer the most value for the price it's trading at?
Yeah, I mean, frankly, there's 3 companies that we have buy ratings on that I would suggest here: DraftKings, Penn, and Genius Sports. On DraftKings, it's really for the investor that's willing and able to take that 2 to 3 year time horizon, when you're able to look at 25, 26 EBITDA, put a multiple on it, discount it back. With Penn, they're generating profitability now. They have the core regional casino business, but even their interactive segment, it's only going to be a $50 million drag this year. The core US is going to be at least break even. And we think that that's a unique opportunity to play this space and really leveraging that convergence between sports betting and sports media. And then lastly, I mentioned earlier with Genius Sports as the data provider, and really they're using their data contracts to create other businesses. So if you're watching Prime Video on Thursday night and you'll see that Primecast, the alternative broadcast, well, a lot of that is powered by Genius Technology. They also have a ad serving capability where they're helping sportsbooks acquire customers. So really leveraging that data relationship with the leagues and the sportsbooks to create a whole nother or other revenue streams about it. So those were 3 picks that I would highlight in the sports betting landscape that we're bullish on.
Well, Bernie here's hoping for a better week 4, maybe for your wallet. Bernie McTernan, Needham Company Managing Director. Always good to have you on the show. Well, if your summer utility bill sends a shock through your wallet, you may want to brace yourself for more high prices come winter. Some estimate households could be paying up to 25% more to heat their homes this year. Joining us now is John Bartlett. He's president of Reeves Asset Management. John, it's good to talk to you today. We just said 25%. I've seen some estimates that put it at about 35%. How painful are things about to get?
Well, I think we're going to see the worst of it this winter. That's the good news. It is. It really depends on where you live and how you heat your house and how your utility generates its electricity or buys it on your behalf.
And John, talk to us a little bit about the impact of natural gas on utility companies today.
Sure. Well, you know, natural gas is the fuel that sets the price of electricity. The last generator that comes on is usually a natural gas facility, and that's the one that sets the price. Generally speaking, your utility is buying natural gas either to fire its own generating stations, or it's buying natural gas for you to heat your house. They're buying it all year long, and when we get to the winter months, roughly half of the gas that you're burning in your house is coming out of storage, and that gas obviously was bought much earlier on in the injection season.
Yeah. So what's actually driving these prices to these levels? Is it a simple supply demand dynamic?
Yeah. Well, in this winter, it's just simply that, and it is something that is, you know, as you can imagine, the best thing for high prices is really high prices, and we're seeing that at work right now. That is the confluence of supply and demand really adjusting to a little bit better sense of equilibrium.
So how should investors play the utility space? Because I'm taking a look at our Wi-Fi Interactive board, our charts for the sectors. XLU is down more than 1%. Outperforming, though, the broader markets, as you're looking at the S&P down year to date, 22%. XLE, of course, is the major one that's gaining this year. But so how should investors play this? Do they continue with utility stocks if they're in these, or do they sell and take some profits off the table?
Well, you know, I think as far as utilities go and their relationship to the rest of the market, what you see is what you get. And what we've experienced this year is significant outperformance, really on the backs of the fear trade and also a fundamental improvement in the industry. And that's not insignificant. Generally speaking, if you kind of look at long periods of history, utilities tend to be fairly correlated with interest rates, but they also generally tend to do a little bit better than you might expect during periods of inflation. And that coupled with really the backdrop of what's been very constructive regulation, not only at the state, but also at the federal level. Utilities have had a good run. And I think what you can expect is your dividend yield plus your earnings growth on an ongoing basis. There are some PEs that are probably a little too high, and there certainly aren't any places to go bottom fishing in utilities. But again, I would go back to my earlier comment. What you see is what you get: earnings plus dividend, and a very strong outlook.
I mean, is this sort of similar to what we've been seeing when oil and gas companies? I mean, oil companies, we're talking about natural gas here, but, we've seen the profits go up on the back of consumers who are the ones that are having to pick up the load. And yet it's been incredibly profitable and good for investors, too. I mean, is that sort of how investors should be looking at these utility names as we go into the winter months and look at these major price hikes?
No, I don't think so at all. All of those companies profit on higher commodity prices. Utilities really only have their fortunes based on solid regulation and the investments that they have in their companies. So if the price of natural gas goes up, it really is a pass-through from the utility to the customer. So it's an unfortunate situation for the customers. It also, no utility likes to see bills go up. A, because they don't have any benefit from it, but B, it's just not good for their relationship with their customer and their regulator. So, again, I don't think you have to worry about, whether or not the commodity is going to affect the profits of these companies. And you certainly shouldn't be investing in utilities to, say, go long natural gas or something like that. So it is, again, these are conservative investments. Plenty of stocks that yield, well over 3% have their earnings growth, in excess of 5%. So the opportunity for a, kind of high single digits total return is, plus or minus a little something from the stock market. Is very visible at this point.
Yeah, well, a lot of Americans bracing for some sticker shock come winter. John Bartlett, president of Reeves Asset Management, appreciate your time today. Well, the sterling has slumped to a record low against the dollar thanks to a combination of a soaring greenback, and concerns over the UK's latest budget plans. Speculation has now been ramping up throughout the session that the Bank of England could step in with an emergency rate hike. The euro, by the way, also slumping to a fresh 20-year low today. This amid major political moves in Italy. The nation now has its first far-right government since World War II. Giorgia Meloni, leader of the Nationalist Brothers of Italy, leads the bloc. Joining us now to walk through all of the FX moves for us, Citi's head of European foreign exchange strategy, Vasilio Giannakis. Vasilio, where to start, right? Let's start with the British pound, because you made the call last week that you expected it to reach parity to the dollar. Certainly it feels like it's moving in that direction. What has been driving this kind of reaction in the market?
Well, for sure, there's definitely the element of dollar strength. But as far as sterling is concerned, it's clearly on the back of the UK fiscal announcements. I think the market is taking the view that the sizable tax cuts, the biggest tax cuts we had since half a century now, 1972, which are going to be financed by borrowing predominantly, are likely to be unsustainable. And basically what you're getting is an erosion of confidence to the UK economy. And that's why you see sterling plummeting. Obviously, there is a very high likelihood that the Bank of England may step in for an emergency, as you said, rate hike. I think, if and when that happens, I think will provide some stability, but I think by and large it's going to be very short term. I still stand by the view that sterling will have to depreciate further, basically to compensate investors for higher UK risk premium.
The timing of all this certainly raising a lot of questions. Obviously, the Truss government just starting things here, going bold, as some would argue, going for these kind of tax cuts. But also, you've got the UK dealing with record inflation, not unlike other countries, but the question about why, in fact, this is the time to be doing it. How does it complicate the outlook and the trajectory for the Bank of England as they move to rein in inflation?
Well, to your first question about the timing, I think by and large is based on what I consider to be a misconception. It's quite clear, we've heard it from the Chancellor, they're targeting 2.5% growth. But the idea, this notion that governments can actually target and deliver on that target has absolutely no empirical and no theoretical backing, basically. In terms of complicating the backdrop, it's certainly complicated a lot. First of all, you have an already high inflation. As a matter of fact, the UK is running the highest headline inflation relative to the rest of the G10 economies. And secondly, it will be happening in parallel to the initiation of quantitative tightening by the Bank of England. So basically, you're going to have the Bank of England gradually offloading its stock of government bond purchases in parallel to the Treasury flooding the market with yields.
Vasilios, the moves in the U.S. dollar against other currencies has just been parabolic. I'm going to pull up our Yahoo Finance chart, and you can see the U.S. dollar index is against a basket of currencies year to date up 18%. You've got the U.S. dollar against the Japanese yen up 25%. How sustainable are these moves, and what will it take to cool off the U.S. dollar?
Well, first of all, from purely from a valuation perspective, I have little doubt that the dollar is very much overvalued. But that being said, historically, what we find from an empirical perspective is that the two things, when they happen together, tend to be the most favorable environment for the dollar, and that is the Fed hiking rates and at the same time global growth. And this is pretty much exactly what we had so far this year. And I have to say, this is what we're looking to get over the foreseeable future. It's pretty clear the Fed is in very bullish stance, unconditional commitment to tame on inflation, even if that means demand destruction. So further rate hikes, final real yields will go higher in the US. And equally at the same time, we're operating in an environment of very sluggish growth with no prospect actually of coming out in sustainable basis anytime soon. And it's important to watch. The stimulus has been half-hearted and therefore not enough to bail out global growth.
Finally, the other central bank we've been watching closely, the Bank of Japan. We should point out the only major bank that still has a negative interest rate policy in place. We've been talking about the strong dollar really driving the yen despite the intervention that we saw from the BOJ last week. You know, the argument for a very long time, at least in relation to what's been playing out in Japan, is that a lot of the risk is contained because so much of the debt is held domestically. When you think about the huge swings that we've seen in the currency and where the BOJ is moving, does that argument still hold?
Well, look, I think there is a validity to that. One could equally say that if we were the possibility of significant debt being held by four, that would have resulted in a much stronger rally in dollar yen. But I think the fundamental driver for this year's dollar yen significant depreciation, around 25%, has been the move in US. That seems to be a bit delinked right now because of the verbal and the action that we saw last week. But again, I would caution very much that terms, especially the ones that are not coordinated amongst different countries, are not typically successful. So I think the Ministry of Finance has been more two-sided, two-way volatility in the market. Again, I don't think that it will be able to basically curb the trajectory higher for dollar yen.
We'll be watching Vasilios Giannakis, Citi's head of European Foreign Exchange. Thanks so much for joining us.
Well, now let's take a closer look at the broader markets with Charles Schwab Chief Global Investment Strategist Jeffrey Kleintop. So, Jeffrey, as you're taking a look at what markets are reacting to right now, and you're really saying the currency story is the one to keep an eye on. What are the currency markets telling you right now?
I think that's true. You know, stocks have completed this round trip voyage and at their new all-time lows for the year. They rose over the summer, but then have come all the way back. And European stocks have now entered into a bear market as equities rallied from mid-June to mid-August this year. The currency market was skeptical. The dollar continued to rise as this safe haven trade continued in the markets. It's difficult for me to imagine a durable rebound in global equities without the dollar at least stabilizing. And clearly, there's no signs of that today.
Jeffrey, taking a look at the declines once again today, coming off what was a brutal week for the markets last week. At the levels that we're looking at today, do you think we're near the bottom?
Well, that's hard to say. I think one of the concerns is, are we going to get a mild recession or a deep one? I think a mild recession is probably more than priced in at this point. The question is, how much deeper is that going to go? Of course, that's very dependent upon central banks. Do they continue to push higher and higher, wanting to be the Paul Volckers of their era until they get policy rates into real positive territory? Right now, monetary policy interest rates have moved up, but they're still very negative on an inflation-adjusted basis. Big moves would be required to get them into positive territory, as Paul Volcker did back in the early 80s. So if they do that, that's an ugly economic scenario. I'm more hopeful that housing begins to come down, rents begin to come down, and inflation begins to abate later this year in a weaker labor market, but that's yet to be seen. So there are several different paths that the economy can take from here. I think the outlook for a deeper recession would certainly suggest stocks could come down on a much deeper decline in earnings. Remember, it's just been the price to earnings ratio that has accounted for the losses so far.
And so how will you know when you think that the Fed is really near its peak hawkishness?
Well, there's a few things that we can watch. For one thing, we can look at other central banks around the world who may be leading the Fed. About a year ago, we saw rate hikes by the Central Bank of Brazil for emerging markets and Central Bank of Norway among developed markets, a big G10 central bank. They have now indicated that they're probably done. The Bank of Brazil did not hike rates in September after hiking in August, saying they were finished. And the Bank of Norway did hike by 50 basis points, but said they are probably at or very close to the end. They led the Fed by about 6 months. So if that's the case, maybe somewhere in the first quarter of next year, we might begin to see that the Fed can begin to put on the brakes or at least pause for a while and see what's going to happen. But so much is dependent upon rents. It's 40% of inflation, and rent prices are going up even as housing prices come down. Until we see that break, probably due to a weakening labor market, we'll continue to see the Fed pushing down much harder on that brake pedal.
Jeffrey, earnings are going to be in focus here over the next several weeks. They've now kind of been joining inflation, joining the Fed moves as really one of the big concerns here for investors as we start to get those third quarter results. Do you think we're going to see more downward revisions when it comes to earnings? And what are your expectations?
I do, and I just put a chart on my Twitter feed related to this. So we have not seen the normal downward revisions we'd see going the next 2 or 3 or 4 weeks before the earnings season starts. You usually start to see some downward revisions to earnings estimates, and we're not this time. For looking at a global basis, they're relatively stable. That tells me expectations are probably a little bit too high going into this earnings season. Not only have there been unexpected developments take place that could have caught business leaders off guard, but I think their guidance out to Q4 and Q1 of next year, where we're likely in a global recession, probably need to come down as well. So again, I think that earnings, which have been a support to the market here, expecting to rise a few percentage points this year, maybe 5% next year for the S&P 500, the Stock 600 in Europe, the Nikkei 225. I think those are a little high. I think those numbers are going to come down, and we may be hearing about it in the next few weeks.
Mm-hmm. So then, Jeffrey, how is that informing your strategy for right now for investing?
I think investors want to focus on quality stocks across sectors, not just try and pick out a sector or two that might be outperforming. One of the ways we've defined quality this year are what we call short duration stocks, companies that get more of their cash flows in the near term than out over the next several years. So that's a lower price to cash flow ratio. Those stocks have been outperforming since interest rates began to rise back in August of 2020. They've outperformed all this year and even in the month of September. So focusing on that is important. Second, I think high dividend payers, a very similar theme. Companies paying a high dividend generally have good cash flow and strong balance sheets. Those stocks have been doing very well this year, not avoided losses, but really have only experienced about half the losses of the overall market. So that's another theme investors want to keep in mind. High dividend payers in every sector are outperforming. You don't just have to go to those classic high dividend payers in, say, utilities or telecom. You can find them even in the tech sector. The highest dividend payers are the outperformers.
Jeffrey, if you have some cash on the sidelines right now, like some of our viewers likely do, are you putting money to work, or should investors wait maybe for some of this volatility to calm down?
Well, I think you can use volatility as your friend. If you've got a long time horizon, you've got some cash, I think dollar cost averaging into this type of a volatile market does make long-term sense. I think trying to pick a bottom is very hard. Increasingly we're seeing more value even in the bond market despite the sell-off there, with high yield bonds now yielding over 9%. We've got dividend yields in the U.S. are now higher than they've been in quite some time. So I think you have the opportunity to buy in and wait and pocket that yield even as you wait for prices to recover. recover.
And Jeffrey, what are you steering clear of in this environment?
Well, I still think there are some stocks that really benefited from the liquidity wave of recent years in the tech sector and in other areas that long duration stocks, those companies with very lofty growth prospects in the future. As liquidity continues to be drained and financial conditions tighten, those may fare the worst. So those are the highest price to cash flow stocks, what we call long duration stocks. You can find more of those in the growth sectors of the U.S. stock market.
Jeffrey Kleintop, always great to get your perspective. Thanks so much for joining us. Well, big story of the day, the British pound falling to an all-time low against the dollar in earlier trading, prompting speculation that the Bank of England may have to raise rates more aggressively to tamp down inflation. Let's bring in Mark McCormick, TD Securities Global Head of FX Strategy. Mark, it's good to see you. So we have a surging dollar, the pound plunging, euro at a 20-year low against the dollar. Just help us make sense of the moves that we're seeing in the FX market and what this means for retail investors.
Right. So this is a function of global dynamics, global growth dynamics, which you just discussed. This is also about central bank policy, the inflation theme, and also terms of trade. What's happening in Europe is they're dealing with a massive terms of trade shock, which means the cost of imports are rising. They have no control over energy prices. And so real rates, the rate the central bank has, nominal rates minus the level of expected inflation, are moving against European currencies, which is pushing them dramatically lower. If you think about sterling, what we got is basically a fiscal package, which is there to design to support growth, but it comes with basically no tax revenue buildup. All of it's supposed to come through economic growth. There's no real challenge to how they're going to spend money. And so basically there's been a loss of confidence in the gilt market in sterling. So that's why we've seen the collapse there.
And for multinational companies who are watching this happen, what do they need to be keeping an eye on right now?
Well, yeah, you have to think about how these three factors work together. We've got the global growth dynamics, which are quite important. You have to think about what's happening in China. Again, we still have the zero COVID policy. We're on and off in terms of whether or not things can grow there. What we have is basically Asia and China in general is trying to ease financial conditions. They're cutting rates. They're trying to stimulate growth. They are dealing with low inflation. In the U.S., it's different. The U.S. is they're trying to tighten financial conditions. They're trying to raise rates. They're trying to take some steam out of markets in general. And in Europe, the financial condition shock has been imposed on them, again, by these forces related to the cost of energy and electricity and the terms of trade shock. So I think what investors need to kind of keep their eyes on is really all the world's most important regions are divergent. And the way that the world kind of absorbs these shocks is through the currency market. And that's why there's so much volatility. This is why currencies are doing different things in different regions. But the key thing in the very short term to keep your eye on is we have an inflation report coming up that's going to be very critical. We had a very good inflation report, then we had a very bad inflation report. And now we've seen, again, a pivot in the Fed's relative hawkishness, which kind of dovetails with what we've seen in the latest report. But if we get an inflation report that's a little bit more benign than market expectations, we might see some pressure come off in the very short term. But again, for the next 3 to 6 months, we're still dealing with a challenging global growth environment. We're still dealing with persistence in terms of figuring out where central banks stop in terms of their terminal rates. And then lastly, again, this ongoing terms of trade shock is not going to dissipate through the winter unless we get very lucky and have a warm winter in Europe.
Mark, it doesn't seem like anything is stopping the dollar's momentum, at least right now. What's it going to take in order for us to see the dollar peak?
Yeah, it goes back to the inflation in the very short term. We have these indicators, we call them stagflation indicators. What we're doing is looking at relative global inflation versus relative global growth expectations. Dollar's running about a 12% premium, which is pretty unheard of in a framework like that. So if you kind of look at also the correlation of the 60-40 or the risk parity portfolio, the dollar is like the perfect stagflation hedge. You get a little bit of a yield. It's negatively correlated with equities. And so if you have a bearish view on equities and credit, the dollar is a great place to kind of sit there and wait things out. So for things to change, we need to see inflation numbers. And again, I think what people are a little bit too focused on the core numbers, because core is 40% of that is represented through the housing market, which again, the Fed has very little impact on the housing market in the very short term. But I think the things we want to continue to see is the downside in commodities, the slower move in producer prices. Again, the fact that we're seeing supply chain indicator stress start to alleviate are good signs, but we need to see the next inflation report come in line expectations with markets. That'll help cool things a bit. But for the full turn in the dollar, we're going to need to see the global economy start to recover. So we'll need Chinese financial conditions to kick in. We need to see Europe kind of work through this terms of trade shock, which is going to, again, take us through the winter. And we have to see kind of global peak inflation. So those are the three factors.
And Mark, not to put you on the spot, just when we're trying to gauge, I guess, where we're headed from here, 6 months from now, where do you see the dollar?
So I'd say in 6 months, it's still relatively resilient. I'd say if you want to go 9 to 12 months, we have a very big drop expected in the dollar. I think one of the things that people have done through COVID, which has been very challenging, is you're kind of taking these peak extremes that have been pulled in through the pandemic itself and extrapolating. You know, if you extrapolated from where we started with COVID, we would have never seen a recovery in the economy. We saw a massive rebound in data surprises and data expectations through, right after the economy started to reopen. We had a massive reflationary trade because of all the stimulus we got. Now we've seen the removal of the stimulus and some of the normalization. So I think to extrapolate this world, the one we're in now for the next 12 months is going to be challenging. I think the next 6 months, we still have the dollar generally resilient, but I think it's starting to turn over and we're starting to forecast a lower dollar 6 months out. I think if you want to go 12 months, we do have the dollar falling by, the levels of some of the risk premium that's embedded there by 12 to 14% against specific currency pairs.
And Mark, I just want to quickly ask you about the new Italian Prime Minister, obviously Italy, the third largest economy in Europe. What are you keeping an eye on there? And do you expect any shifts as a result of this?
No, it's very interesting that for the first time, Italian politics has taken a back seat on European currency moves to UK-based politics. I think, again, what people are going to be watching here is the BTB bund spread. Is there a lot of pressure? It does seem like a lot of what we've seen from Italy has been a lot of rhetoric, and the rhetoric so far hasn't really matched anything in terms of policies seemed a little bit more tempered relative to expectations. The prime minister was kind of saying the right things. So I think in this regard, Italy's kind of a secondary force. I don't think it's a big driver. I think we knew where we were going. So there's not too much that we're watching there. I think you're going to want to see some of the spots, who's going to be leading the finance ministry and some of these key appointments. But other than that, the market's just going to continue to monitor the BTB and bund spread. But for this moment right now, euro sterling and European currencies in general is really going to be dominated by what's happening in the UK fiscal policy rather than European politics.
In this episode of Influencers, Dice founder and CEO Phil Hutchin, along with Tony Fadell, Dice board member, Nest founder, and inventor of the iPod.
humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your lives.
There's always unintended consequences in everything, and technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Phil Hutchin, the founder and CEO of Dice. Also, Tony Fadell, a board member at Dice. Tony, as you may know, former Apple executive, iPod inventor, iPhone co-inventor, also Nest founder, and a principal at Future Shape, which is an investment and advisory firm working with engineers and scientists, developing foundational deep technology, I should say. Got all that. Okay, we want to talk about Dice. And Phil, why don't you start us off by telling us what Dice is all about and what you guys are doing?
Yeah, no problem. And nice to see you, Andy. Well, first of all, Andy, have you ever bought a ticket?
Yes, I have.
And how was that?
Not so good, Phil.
And so I think that every time we kind of ask someone if they bought a ticket, that has ever come back to me with like this, like, oh my God, it was amazing. It was always like, I bought a ticket, I thought it was one price and it was another price, or I couldn't buy a ticket and it was thousands of dollars or whatever it was, or, I missed out on the show, whatever it is. And so there's lots of problems around it and, the opaque nature of the industry. So Dice is a super simple way to find out what shows are going on. 2 taps and you've bought the ticket. It's killed scalping. And if you can't turn up to the show, you tap a button and you get a refund. And it's just making all those things traditionally associated with, going to a live experience, they're gone. And now it's just very easy.
I have a million more follow-up questions and we'll get to them. But Tony, I got to ask you, you joined the board of Dice in September. What made you a believer? And why join at a time when the live music industry is still getting back on its feet with COVID?
Sure, Andy. As well, it's great to see you. So for me, music's in my blood. Given my past, and I'm from Detroit, right? So when I was in Detroit, exactly, Ticketmaster first came out, and it was like a revolution. I could go walk down to a local store and get a printed ticket. You didn't have to go to the box office, and so that was an incredible innovation for me. But since that part, they haven't innovated a lot. It's still like, okay, what can we do to extract more money from the fans? Really, is what it is. And it hasn't been about more convenience, about more access, making it easy. You can say what you want about airline ticketing or other travel ticketing. At least you can exchange tickets, upgrade them, change the dates, everything. You don't have any of those conveniences at all in the entertainment ticketing world or sports ticketing world. Well, that's what Dice is trying to solve. And because I'm such a music fanatic and have been suffering with these things for years, I met Phil, and I didn't just get involved with Dice this year. I've been involved with Phil and Dice, 5-6 years now. So this was like literally when they were like 10, 12, 15 people. So we've been working together with them and just been, because of the experience that they really want to bring. Fans first. It's all about the fans. Even the artists, the venues, everyone understands that. More fans. And especially today when, bands are not making any money except for merchandise and for entertainment events. Other than that, they're not making any money on streaming. We see that unless you're the top, 100 artists, they don't make any money. So where are they going to make their money? And how are they going to make sure the fan has a great experience? That's what Dice is all about.
Phil, I got to ask you about the competitive set. I mean, Tony mentioned Ticketmaster. They're still around. StubHub, Eventbrite. What sets you guys apart from those companies, and how are you going to build your brand?
Right. So I think I kind of touched on it. Like, our only customer is the fans, and that was something that we established on day one. So everything that we build is for that fan experience. So when we're building things with partners or venues or artists or anything else, we always ask the question: is it good for the fan? And I think that the second thing is that Dice is just software. So, if you're looking at Live Nation, I mean, they do huge productions, they do all these things, Ticketmaster is part of it. we just like the using software to bring fans and artists closer together, like helping them decide which cities they're on, how much they should be charging, all these things to make it super efficient. And I think that the third is that we're able to scale much quicker around the globe. So I mean, we started off in London, but now we're in the US, in France, Spain, Italy, India, Australia, moving into Southeast Asia. So it's like it's kind of, there's a global network effect that happens as well, because you're giving that data to artists to help them plan global strategies themselves. So it's just really, when we're talking about empowering artists, it's like helping them control their cash, so they own the cash. They can pay people and do things instead of waiting for someone to pay them.
How do you mitigate against scalpers? You mentioned that. Can you drill down a little bit more there?
Yeah, cool. So this is, I mean, it's like one of these things where in hindsight it's like so simple, but there's nothing to sell. When you buy a ticket on Dice, there's no ticket. And so there's nothing to screenshot, there's nothing to pass on to somebody else or anything else. Just moments before the show, there's like an animated a QR code that goes around, which is there. But it's a very elegant, simple solution, but it's a way that if you've got nothing to sell, then it's impossible for scalpers to put it on any platform because they don't have anything.
And how much of the business, Phil, is reliant upon the return of live music to pre-pandemic levels? And what is your prediction about when that'll happen?
So we've spent 18 months, or give or take, and like sort of stock in our homes been entirely digital. And you're thinking about one of the things that I didn't appreciate, at the beginning of Dice, and kind of really kicked in sort of just before the pandemic, is that we saw some data in terms of loneliness for people aged between 17 and 21, and a third of them expressed that they had intense periods of loneliness. Even before the pandemic. You put the pandemic on, everyone kind of living digitally. The return to live since summer, it's been insane. I mean, every record has been broken at Dice in the last, 5 months. When we're looking at the data, like still now, shows are completely packed, like the venues are packed, everything else. You read in the newspapers that people have become hesitant about stuff, and then you go to live concerts and they're absolutely full. And I think it's kind of going back into what I was talking about with loneliness, that humans need to be around other people. I mean, it's one of the things that make us like human, and seeing like an amazing performer is one of the things that you remember for the rest of your life. So live experiences, I think that people are actually appreciating them even more as a result of the pandemic.
Yeah, Phil, I've been giving Tony grief about musical preferences. I'm going to hit you a little bit. Like, I don't know if it's Adele or Coldplay. You know, I'm doing the UK thing with you. So do you work with the artists or do you work with the venues? So in other words, here in New York City, MSG, Madison Square Garden, are you selling tickets for them or are you selling tickets for Adele?
So we do it for both, but the focus is largely on venues because many artists play venues. But we have an artist development team, and that's part of the idea of the global network is that Dice has venues all around the world, and then artists want to play those venues, and we help them kind of connect them with those venues via their agents or the bookers or whatever else. And then part of that is, so I've got an example. So it was an artist in London called Bicep. They started off with us from the very first show, 200 people. And we made the deal with them, like, cool, sell exclusively through Dice. And let's kind of like build up this live story. And then from that, you're not allowed to spend any money on social media advertising. You got to trust into your audience, but get the story right. Now they can sell 50,000 tickets in London. And it's kind of like taking them at each of those steps all the way through. And throughout the whole time, Bicep understood their audience. They knew what they wanted, where they wanted to play. They had control over, their live strategy. And this is what we're doing at scale now.
Right. And so do you cover all the venues in the world, or do you have to, are there some venues that are not a part of your ecosystem yet?
Yeah, so we wish we had. Well, we have all the best ones, or most of the best ones. So there's some holdouts, but there's other people who have the ticketing rights for those venues. But we have it's 3,600 venues sort of around the world, which is increasing, day by day. And we also work largely in major cities. So in New York, over 1 million people used Dice last month. And so there's quite a big spread of venues in New York. And for that, it's the same in Paris and Barcelona, all these things, because there's lots of events happening there. So the discovery engine is really kicking off. And our thing is that if you want to see a show once a month, then let's get you to a show once a week. How do we reduce the friction for you to actually get there? So our competition is like people staying at home watching Netflix. Is like, okay, well, how do we make it as easy and compelling to kind of get out and see something? And it works. I don't think anyone's been to a great show and said, well, I'm not doing that again. So it's the exact opposite.
Tony, while I have you here, I got to ask you a few questions about Apple and the iPhone, Silicon Valley.
Oh, God.
So you were on the cutting edge in designing the iPhone, but it's been around for a while. What do you think is kind of the next big thing in terms of consumer tech? Thoughts on the metaverse? Those are two big questions happening right now.
Well, the big things on the horizon for consumer electronics, we're hearing more about, augmented reality and these kinds of things. We're hearing about the metaverse. Frankly, I think we got a lot of fish to fry, and we are frying ourselves. So I think we need to spend more time on fixing the climate than we need to worry about getting into the metaverse. So let's make sure we have an environment to live in before we find another environment that, keeps us in like refrigerated chambers and, so that we can breathe and eat. So that's how I feel about the metaverse, but on consumer electronics, I think, a lot of this stuff, people think that this is going to be the next big thing, like augmented reality. I think it will be for certain very niche verticals, but not necessarily like the consumer thing that you need. Because, we saw this before. You got to need the technology, and then you have to understand that the consumers want it, right? And they want to live in that, live with these things on it. And it's social acceptance, not just you accepting it, but the people around you accepting it. And that I've learned all the time is the technology might be right, but is the social timing right? Is there a social acceptance? And are you truly delivering a pain killer because there's a clear need? There's a clear pain. The iPhone solved a need, right? It was on the go, internet, email, media, these kinds of things. We don't see the need yet for the metaverse. And then to have the metaverse wherever you go on you, we already tried that with Google Glass. I think it's going to take a little while.
Yeah, and speaking of Google, you helped create the iPhone, the iPod Nest, which was bought by Google, and these products are networked now in a huge way. What is your take on both the upside and the downside of this massive amount of networking that some people say, leads to dystopian possibilities, but also tremendous upside?
Well, look, there's always unintended consequences in everything. And technology is neutral. It's what we choose to do with it and how we regulate it and what we socially accept. So we have to do things that promote social bonding, like what Phil's doing with Dice, right? Not letting the ticket bots in there, not letting the scalpers in there, doing all the things necessary. And that's why I love what Phil and Dice is doing, is they're trying to bring all the best things to connect the artists to the fans, right? And getting rid of all of those middlemen who are just stealing along the way. So that's what we want to do. And I love the network. It can have better shows, have the artists make more things for their fans so that the fans have a better and better experience. And maybe through that, we can create even more social movement to fix some more of these problems. But it's about bringing people together and not about a network of intermediaries stealing along the way.
All right, just one more Wayback Machine question.
Okay.
Okay. And that's, you worked with Steve Jobs.
Yeah.
Apple built a music business when you were there. What did you learn from Steve, and what do you think he'd be thinking about the world today and the technology that we're using?
Well, I think for me, what it was all about in the music store and the iPod, it was always about, what do the customers really want? What is going to give them that that emotional experience that they crave, that they want, and a rational part of that, making it simple and all those other things. And that's that's like Dice. So when you see something like this, you're like, wow. I think that if Steve was here today, he would go, we need to get artists more money. I think if he looked at the streaming services out there, I know how much he loved musicians, bands, and wanted to support them. I remember way back when he was looking at buying certain media companies, that kind of stuff, because he really wanted to revolutionize that. And so as far as I'm concerned, if he woke up today and saw the streaming services the way they are today and where the artists are not getting fairly paid, he would fix that. Absolutely.
I remember Tony and Phil when he came by and demoed the iPad at Time Inc. when I worked there, and he played music and he played Friend of the Devil. And I said, oh, the Grateful Dead. And he goes, I love the Grateful Dead. You can see he really meant it, right?
Yeah.
He was really passionate about that. you come from a musical background, a music industry background, I should say. But geez, what made you decide to get into ticketing?
Yeah, I mean, I was in tech before going into the music and not knowing anything about the music industry. So very naive, but very lucky in the music industry that, found, some artists who were getting bigger and bigger. And actually didn't care about ticketing, didn't understand it, because you spend so much time, working with the artists and making an amazing album, making amazing artwork, looking at their live show, and didn't think about the ticketing until the artists started getting bigger in North America, and that was when I suddenly was like, hang on a minute, we did a deal for $40, and now the ticket's 65. Where's this 25 going? It's sold out, and it's been sold for hundreds, thousands of dollars, and all the fans are angry at the artists. Like, why isn't anyone fixing this? And so then I went back into sort of old world, new world together, and just analyzed all the ticket companies and tried them all out. Didn't want to, just trying to see if there was a solution. And that was the thing. Well, if no one else is going to fix it, I guess that we have to do it. So, and kind of just touching on to the last question as well. I think that take a lot of inspiration from what Tony created. Really thinking about the small things, the experience when someone sees it, small little animations within the app, the ticket, the imagery. You're talking about brand before, like people wear Dice t-shirts and have the bags and everything else. Like all these things are like things which we really care about, because you need to make a revolution, and all this stuff like pays off because eventually, because of all these things being put together, artists make more money in the right way.
I didn't really ask you about the business model, your P&L. How are you doing? How's the company doing? So can you dive into that a little bit quickly?
Sure. As I mentioned before, it was the we in the pandemic and coming out of it was like it's a shock. I mean, we went from no one going out to everyone going out. Yeah, and from 0 people in New York, like sort of going out to 1 million people going out. So we have it's over 1 million in New York in the last month, 1 million in London, 500,000 in Paris. Like all these people sort of coming together. How we make money is that we charge the venues or the artists for using Dice as their partner to sell the tickets. So it's like we're very pro privacy, and so the again, just protecting the fans from this, but also everyone knows like how we make money. We make money from selling the ticket. There's no advertising, nothing else that's on there. And in terms of the volume is like it's accelerating as Tony knows, like every week right
well
now.
Let me be clear, we're happily writing checks, and we're backing these guys, and even in the darkest of times, we see the light, and we see the growth, and we see the fans, and they're coming back, right? It's sticky. People love it. They're telling their friends about it. We do very little advertising. I meet a ton of people I go, yeah, I'm an investor in Dice. It's like, oh, I'm a user. Like there's so many people. If you actually ask people in the regions where we operate, there's a lot of people using it. We just don't sit there and market it. And, it's self-marketed because the fans love it. And so that's why we keep investing, because we know this is the future, and it already is here today.
Word of mouth seems to be working. So are you guys venture back, Phil, IPO in the future, perhaps?
Yeah. So yeah, we're venture back and public listing in the future for sure. Yeah.
Great. And Tony, how did you guys meet?
So interestingly enough, I had friends in London, and they said, "Oh, you have to meet Phil. You guys would get along. You love music. He's doing something really cool." And Phil and I just were at a hotel. I think it was the Ham Yard, and we just had a drink, and we just started talking, and we talked all about music, and then we started talking about books, and started sharing titles, and just getting into psychology of like a fan, and what does it mean, and why do we love shows, and really just hit it off. And it was just there. I was like, okay, that's it. And Dice was tiny. It was just a vision. And so it was really about a team and a mission, and Phil as a entrepreneur and visionary.
And Phil, where do you see the company 5 years, 10 years from now? I mean, doesn't it have to become part of one of the, well, they used to call it FANGs. I guess they're MANGs now. part of an ecosystem? Everything's got to be part of an ecosystem. Or can it be a standalone, do you think, going forward?
Yeah, I think it'd definitely be a standalone. I think that live entertainment, how people look at the TAM, the market right now, I think it's undercooked. I think that it's huge. I think that if you've got 90% of the population of the world liking music, maybe half the population loving music, and 30% of people love music so much that they pay to go see it, then that's a massive market. And I think that what we're seeing is growing this around the world. I mean, like, for example, we're just starting off in India. That market could be as big as the US within 10 years.
Right. I love the TAM thing. That is a truly small set. People who hate music. I hate music, right? You don't have to worry about that. That's a pretty small group of people, right? It's pretty funny.
It was the same TAM for the iPod. It was the same TAM for the iPod.
Right. Yeah, that's about right. That's about right. Just everybody. And final couple last questions here. Phil, what do you think that you want to be your legacy?
Wow. I have to think about that one. Okay, you know what? It's the idea. One of the things I love the most, is the idea that we're in Mumbai and there's a scene happening in Mumbai and there's this new music that's happening in Mumbai, and through the connections of Dice, that artist goes straight into the US and Asia and through Europe and blows up. And we do that time and time again. That the idea of bringing culture sort of around the world, that would be awesome.
And Tony, same question over to you. You've got all of these things you've accomplished working here with Dice, and I'm sure you've got all kinds of other things percolating in your brain. What do you hope to accomplish over the following years?
For me, it's really about mentoring and investing my time with the entrepreneurs who are truly changing the world for the better, whether that's environmentally, socially, or for health. Those are the three big things, and Dice is doing that for the social experience all around the world. It's amazing, and that's what I hope Phil is able to fulfill and bring this mission, and I think he's well along the way to delivering.
Well, it'll be great to watch the company grow as we hope we emerge from COVID and live comes back and people get interested in your business. So I want to thank Phil Hutchin, founder and CEO of Dice, and Tony Fidel, board member there and entrepreneur and an executive extraordinaire. Thank you guys very much for your time.
Thank you so much, Andy.
Thanks, Andy. Great to see you.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.